Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage 2022 partnered by ET Now. Just like last year, we are back yet again virtually and bringing you the ninth edition of Voyage. Now, after more than 2 years, after an unprecedented health crisis, a huge turmoil in the economy, businesses, communities and families across the country, India is getting back on track. Now, though some sectors have been altered irreversibly, and some continue to experience aftershocks. Well, the road ahead is still riddled with uncertainty. What does the future have in store for us? How will the Indian industry fare? What are the emerging consumption and investment patterns that are likely to sustain? What is the lasting impact of the new geopolitical developments? Now, those are a lot of questions, and I know you are looking for the answers, and we have all the answers with us here on these 2 days of Voyage 2022. It's in times like this when one needs to stay focused on the end goal and work towards it through rain, shine, or storm. And therefore, this year's theme at Voyage is India Navigating with Resilience, and it was devised with this thought process. Now, as you know, and I'm sure many of you are regular attendees, regular participants at Voyage, like every edition this year too, we bring to you the best speakers and thought leaders who will not only share their insights on how they see India navigating through these turbulent times, but also bring to the fore their future outlook, along with sharing advice for all kinds of possible outcomes. So be sure to log in across 2 days to get a 360-degree view. We have some of the best speakers in the business who are joining us. We have India's current Chief Economic Advisor, Mr. V. Ananta Nageswaran, former banker K.V. Kamath. We have Mark Mobius, Tim Moore, and stalwarts from the Aditya Birla Sun Life Mutual Fund family. We'll have MD and CEO A. Balasubramanian joining us soon, CIO Mahesh Patil, and many more. Now, quickly, as always, Voyage remains an interactive event, so do share your thoughts, pictures, comments on social media. Use the hashtag Voyage2022. Do remember to tag us at ABSLMF. We've got some interesting contests and polls as well. The person sending most number of relevant tweets will win the prize for being the smartest Twitterati of the day. The person asking the most relevant questions or putting in the most relevant comments in the Q&A box at the bottom of your screen will be declared the active Voyager of the day. We have some polls coming up, and the person who answers that the quickest will get a prize. And my favorite contest, the Be Fantastic contest. All you need to do is complete the line, I love hashtag Voyage 2022 because ... complete the line, and the top 3 lucky fans will win some amazing goodies. All right, enough from me. Without further ado, it's time to flag off this event. I'd like to invite the MD and CEO of Aditya Birla Sun Life AMC Limited, A. Balasubramanian, to deliver the welcome address.
Thank you, Sumit. Distinguished guests, our media partners, my dear colleagues, and all those who are tuned in, a warm welcome to each one of you to the 9th edition of Voyage, Aditya Birla Sun Life Mutual Fund Annual Investment Conclave. Voyage, our flagship event, has become a brand in itself. Looking back at our journey, we started with a humble gathering of 500 participants in the year 2014, which is now spread its reach to beyond 10 million digital audiences from across the world with the help of our media partner, ET Now. Let me take this opportunity to thank each one of you for taking your time out to attend our signature event and for your continued support and association with Aditya Birla Sun Life Mutual Fund. At the end of 2021, the world economy was on the track of recovery. Governments, central banks, and world institutions around the world, through calculated policy measures, had navigated the rough waters of the last couple of years quite successfully. Businesses and people had adapted to a new normal. Old supply chains were being restored while new supply chains were being established. Just as everything was going back on track, the unexpected geopolitical tensions between Russia and Ukraine have threatened to derail the global economy, which has now resulted in the uncertainty of markets and also global economic recovery. These tensions have led to disruptions in global supply chains, which have led to supply chains constraints and therefore having an impact on inflation. Markets, of course, have factored in the geopolitical development and also factored in the possibility of resolution sooner as it can be seen from the recovery of the global equity markets. And the commodity prices should also ease up once the tensions de-escalate. There is a possibility that we may see the world economy move from globalization to regionalization, with the countries looking at alternate sources of resources and geopolitical playing a greater role in the shaping the way forward. As we all have witnessed, historically, the Sensex has displayed cyclical tendencies between 3-year time period, but for the overall trend for the past 20 years has been observed to be upward. India has continued to display resilience despite the happenings in the global economy. Domestic investors continue to hold faith in the Indian market through mutual funds as well as the direct equity. This is a great comforting factor towards market stability. To help our investors and distributors understand the economy and markets and make sound investment decisions, we at IISL Mutual Fund, through our flagship annual event, Investment Voyage Conclave, wish to provide insight on the economy and the market outlook by inviting industry experts to share their rich and unique knowledge and experience. Like every year, this year too, we have an exciting lineup of speakers and panelists comprising of policymakers, global industry experts, thought leaders, along with our team to share their thoughts and views on India navigating with resilience. We are optimistic and bullish on the growth prospects of the Indian economy and the Indian market in general. In this edition of Voyage, we want to showcase our resilience through the tough times we have faced in the last 3 years and the optimism we as a fund house has on the growth potential, opportunities, and trends of the Indian economy and the domestic market. I am sure the factors that will drive the growth of the economy will be elaborated on by our CIO Mahesh Patil, along with our co-heads equity and fixed income over the course of the event. Let me now apprise you of the latest developments in the mutual fund industry. The mutual fund assets base, as is known, has grown and reached a total size of 38 lakh crore average assets under management as of December 2021. The industry has attained scale over the last few years due to increased financial awareness and higher digital penetration through our business partners. The retail asset base of the industry has crossed 20.86 lakh crore. The monthly SIP book for the industry stands at 11,305 crores with almost 4.9 crore live SIPs. The total outstanding AUM under SIP is close to 5.65 lakh crore as of December 2021. The total fully account of the industry is close to about 12.09 crores. While this is indeed remarkable in the global context, mutual fund industry in India has still a long way to go. There lies a tremendous untapped potential for mutual funds in India. As of today, Indian mutual fund investor base comprises less than 2% of the total Indian population when compared to the bank deposit base approximately 167 lakh crore as of December 31st, 2021. The Indian mutual fund asset base constitutes just about 23% of the overall banking deposit base. Mutual funds are an important financial intermediary in developed economies. In fact, US mutual fund industry is as big as US banking industry, which is again well-known fact to most of us. Whereas in India, the mutual fund industry is still maturing when compared with the banking industry. With greater financial inclusion and awareness of mutual funds rising, we should see the investor base and AUM base increase rapidly in the next few years. From our past experiences, both good and bad, and make course corrections wherever they is needed in our thought process, business operation, and investment executions. As I look back, since the first voyage, we as Aditya Birla Sun Life Mutual Fund have grown steadily in terms of asset base, customer base, distributor base, and market expansion, digital adaptations, and penetration of B30 market as part of our growth drive. The next few minutes, let me take you through the journey of our growth story so far. Our overall AUM has increased from 89,000 crores in the year March 2014 to about 2.99 crore as on December 2021, a rise of 3.3 times and absolute growth of 233%. Our equity average asset management has gone up by 10 times from 11,735 crores in the year 2014 in the month of March to 1,21,000 crores in the month of December 2021 at an absolute growth of 939%. As a result of this, our overall equity AUM now stands at 41% of our overall assets base. Our debt average assets management stands at 1,76,000 crores as on December 2021 and has gone up by 2.3 times from 77,000 crores in March 2014 with an absolute growth of 127%. In fact, our active customer base folios has crossed 75 lakhs. In the year 2014, we were present in 96 locations. Currently, we are present in 218 locations. We still have a long way to go. To simplify our product offerings and meet investor needs, we have taken a solution-based approach in categorizing our product under the first solution bucket, that is savings, nothing but liquid schemes, income as a category, wealth as a category, and tax as a category. These four solution buckets are further supported by the value-added products and value-added services such as Value STP, SWP, and CSIP, among others. As part of our continuous endeavor to serve our customers and partners, we also introduced the virtual relationship manager model and service to sales model in the current year. Let me now highlight our strategy that has led to our growth in the past 9 years. There are 3 P's which we believe are important, namely people, performance, and processes, along with the 3 C's, which is nothing but clarity and commitment and consistency, with a clear motto of making it win-win-win for our investors, distributors, and the whole ecosystems. Our continuous endeavor to increase our geopolitical footprints has done well for us. We have penetrated and deepened our reach across locations through various modes of presence, such as our branches, hub locations, building our emerging market channels. Our planned strategy is to eventually be present and operational in all the 543 member of parliament locations. This is part of our broader objective of financial inclusion of the country that will help in nation building. Our strategy of continuous engagement with valued investors and partners has enhanced our mind share. Consciously, we keep stepping up our engagement efforts year after year. We take immense pride and in the work we do in the areas of financial literacy and awareness as part of our investor education initiatives. This year, we have even introduced for her, targeting the women investors in the country, an exclusive initiatives that we have rolled out as part of our financial awareness increase across the country. With the acceleration in the adoption of digital technology across all aspects of life, we too have embraced technology and have been at the forefront in upgrading and updating our digital assets in order to widen our customer base across different parts of the country. We continuously strive to provide best investment experience. I am proud to say that we have the best talent to manage the money of our investors. I am also happy to say that we have been a consistent performer and delivered better performance in comparison to our large peers in the industry. While delivering consistent investment performance, we are also looking to the ever-evolving need of the investors by increasing our product offering in all categories. In our efforts to serve our investors better, we have stepped up our offerings in the alternate strategy segment of our business by creating differential product across the passives, PMS, and AIF categories. We expect the passive category to grow exponentially, while at the same time we see actively managed funds and passively managed funds will coexist to cater to the different needs of the investors and different type of distributors, and therefore providing a greater solution to the customers. I'm happy to share that our passive AUM has grown by more than 3 times from 1,692 crores in the month of March 2021 to close to about 600 crores as of December 2021. Winning awards and recognition from external reputed agencies is a validation of rewards, efforts, and dedication. I'm sure all of you will feel happy about the recognition that we get from the external world. Our investor education team won the Asia Asset Management Award for the best fund house for the investor education program in the year 2022 for the fourth time in a row and fifth time in the last 6 years for the innovative approach to investor education and distributed development. Our digital and IT team has won the Asia Asset Management Award for the best fintech innovation in the year 2022 for building a robust digital interface and infrastructure. As we move into the new financial year 2020-23, I am hopeful and optimistic about the growth story for the mutual fund industry and the domestic market and the broad economy as a whole. The Union Budget, which was released in the month of February, announced by our Honorable Finance Minister, Srimati Nirmala Sitharaman, in the month of February, has been well received by the market. It has clearly given a lot of emphasis on the need for investment-led growth by way of increasing the capital expenditure quite substantially. In addition to this, encouraging state governments to undertake more investments, the development of the state infrastructure by keeping higher allocation towards state budget is also a very good move. The focus is clearly to create supply-side linkages and develop the economy in a sustainable manner by stimulating local demand. This budget is not one of those typical one-year plans, but attempts to lay the foundation for the next 23 years. On the basis of this, India is poised to become a $5 trillion economy thanks to the efforts and policy decisions of the government and the policymakers. From an equity market point of view, the budget has set the tone for higher growth through higher spending, which would drive profitability. Many mid and small-sized companies would get benefit from the urban and digital focus. The Reserve Bank of India governor even promised to do whatever it takes and what is necessary to support the economy. The monetary policy has been accommodative in its stance since the pandemic and has kept the policy rates unchanged for the 10th time in a row. Of course, the recent policy we'll have to just see as to how the policymakers will start thinking, especially in the emerging world. The RBI has said many number of times, continued policy support is warranted for a durable and broad-based recovery. The government and RBI will work together to support the economy and ensure the economic growth with price stability, despite there will be a marginal rise in interest rates. The Indian economy continues to remain resilient in comparison to other emerging economies, including India. The happenings on the global stage have impacted equity markets around the world. The recent market volatility is, in fact, the reflection of these dynamics. The last 12 months, FAs have been the net sellers in the Indian market, which is again known to all of us, but domestic investors continue to hold faith in the Indian equity market. This is a great comforting factor towards market stability. While the ongoing geopolitical situation continues to cause uncertainty, it can't go on for too long. Any resolution that is arrived at will sharply change the economic outlook and the result in the normalizing of commodity prices and the growth expectations. On the fixed income side, the market will mainly be driven by federal policy and domestic monetary policy actions. With the expectation of rate hikes in the near future, we expect to see a significant pickup in even credit demand, which will result in boosting the economic revival. In addition, higher tax collection of both direct taxes and GST on the back of better compliance should help the fiscal as we move forward. This gives us ample reasons to be bullish on India's longer-term growth and its prospects to emerge as a strong winner among the rest of the global economies, and at the same time gives the business an opportunity to grow and navigate through market cycles. We at Aditya Birla Mutual Fund are extremely committed to participate in India's growth story, while also being a thought leader and large player in the Indian mutual industry space. While market goes through cycles, if one carries a longer-term focus on wealth creation and maintains the right asset allocation without being influenced by the short-term fluctuations, there is a meaningful gain to be made from mutual fund investments. It will continue to be one of the best vehicles to invest in the market, providing a comprehensive solution to investor needs based on the financial goals and risk appetite. Asset allocation is an important investment mantra at any given point of time. The solution offered by us under 4 buckets, savings, income, wealth creations, and tax savings, are designed to take care of the asset allocation needs of the customers. Investors, of course, have to keep in mind the long-term investing as a guiding principle while building their equity portfolio. We strongly advocate having a good mix of large cap funds, flexi cap funds, and balance advantage in the portfolio is key to bring in success in the overall portfolio action. The Voyage conference over the next 2 days will give you more insight into the economy and the investment scenario in general. As I mentioned earlier, all the speakers are subject matter experts who have rich expertise, rich experience in the respective field. I am sure the sessions will provide a valuable insights. I also extend my compliments to ET Now, our media partner, and my special thanks to Nikunj Dalmia and his team, who has been a big advocate of the mutual fund industry space. He has been a tremendous support in framing the flow and the extending coverage of the conference. I would like to take this opportunity to say that we will always remain humble and stay committed to our investors and partners and shareholders and deliver commendable performance to be a leader in the industry in managing assets and the risk, expand the market and deepen financial institutions in the country. I wish all of you and your families good health and happiness. Let me now conclude with a quote by Sri Ramakrishna Paramahamsa. Always look at how far you have come rather than how far you have to go. Always count your blessings, not what you are missing. With this, I'll end and wish all the success and thank you.
Thank you for setting the tone of this edition of Voyage 2022, Mr. Bala. All right, up next, one of our best sessions that we are all looking forward to. We have the Chief Economic Advisor to the Government of India, Mr. V. Anantha Nageswaran, and he will be in conversation with ET Now's Nayantara Rai and Aditya Birla Sun Life AMC Limited's co-head fixed income, Kaustubh Gupta. So over to Nayantara and Kaustubh.
Yeah, thank you everyone and welcome everyone. Especially thanks to Mr. Anant Nageshwaran for giving his time and sparing and to share with his thoughts. Sir, given the constraint of time, let me just shoot away with my question first before Nayantara can come in. My first question to you, sir, is that post-COVID, if you remove the base effect, actual real rate of growth has been hovering between 0 to 2%, while the inflation has been struggling around 5 to 5.5. Now, this looks somewhat intuitively wrong that despite moving significantly away from the trend growth in GDP, our inflation has not come off. So do you think we have a serious constraint in terms of capacity? And where do you think the potential growth for India incrementally after COVID?
Yeah, that's a good question. Of course, I wouldn't necessarily take a look at the growth rate from 2019 to 20 and then say that, the real GDP growth is only up about 2%, but inflation has been between 5 and 6%. And we all know that some of the inflation has arisen globally and in India as well. Initially, last year, it was the impact on wholesale prices, which is now feeding through somewhat into retail prices. And on top of that, we have, energy-related transition, which was held in abeyance for a few months. So I think I wouldn't call it a serious problem. All countries are grappling with both the challenges of maintaining growth rates, while everybody had bounced off the lows of 2020, and in our case, 2020-21. At the same time, inflation issues are coming up because of supply constraints in many commodities and also food food items, and now energy has joined the fray. So this is a challenge that is globally present, and India is facing it as well. But I would still like to say that the Indian economic story is a glass that is more than half full, because overall, given the constraints we face, we have managed the fiscal transition and the challenges, the growth dynamics, and also inflation isn't raging as it is in some countries in the Western world. So overall, yes, I agree with you on the characterization of this as serious challenges, but I wouldn't call them debilitating challenges, because I believe the glass is more than half full.
So, but still, when we debate internally, we are still not able to figure out what will drive next leg of growth in India over short to medium term, given the constraints and given what's happening on the commodity front, and we are a large importer.
So I think the two things that can drive India's growth forward. One is, of course, the government has clearly stepped into the plate with its capital expenditure plans. And if you notice in 21-22, based on data available for the first 10 months, even state governments have stepped up their capital expenditure. Second, obviously, consumer demand has been quite subdued because of the 3 waves of pandemic we have had. And let's not forget that the pandemic hasn't fully disappeared from the headlines, as Indians do listen to what's going on elsewhere. So, and you are seeing that, that as the situation in India eases, private consumption demand is beginning to pick up. Probably it is not yet seen in the data. If you just anecdotally observe in the weekends, in shopping complexes and also air travel, etc., there is a distinct pickup in footfalls. And therefore, once that sustains for a couple of quarters, I expect that the capex spending, which is sort of a coil that is waiting to be unwound, that is tightly sprung, will definitely show its full strength, because the private sector ticks many of the boxes that are required for a capital expenditure revival to happen. And the missing box has been the sustained consumer demand revival. And without any further nasty shocks from the COVID pandemic, I think if that doesn't happen, then in the second half of this year, I expect the private capex spending to take the baton from the government and run with it. So this is how I see the growth momentum shifting from one stage to the other.
Okay.
If I could come in here, sir, we've been saying that this is India's decade of growth, and it has to be growth at all costs, right? We've been getting that. If there is one threat that we're having, and you touched upon a little bit, which is consumerism, while we're seeing revenge shopping, revenge dining, revenge travel. So, I'm going to ask a question on behalf of the Aam Aadmi, and that is with inflation, with Mengai, well, how will the government really help? For example, just look at crude oil. You've not even provided any relief when it comes to excise duty cuts. A lot has been said. Is anything going to happen on that front?
I understand it is important to not analyze these things in a piecemeal fashion. If you look at the government, indeed, last week extend the Prime Minister's Garib Kalyan Yojana for another 6 months, and that is 80,000 crores. And even now, the price of crude oil and the energy shock is a global phenomena. And to some extent, if the government were to sort of focus on excise duty reductions as well, and as you know very well, the fertilizer subsidy will naturally be going up because of crude oil prices as well. So on top of the extension of the Garib Kalyan Yojana for another 6 months. Now, if you also talk about energy excise duty cuts on fuel products, etc., then to the extent that it has an impact on the fiscal balances, then the cost of capital would rise, which in turn will affect all kinds of corporate borrowings and also the interest rates that consumers face also. So consumers will face the cost one way or the other. And therefore, that is why I said it's important for us to look at this not in a piecemeal fashion, but holistically.
Sorry. Doctor, but as you said that probably the private capex on the consumption side will pick up, but now incrementally fiscal has to take a back seat, given that our debt to GDP has already reached 90%, and the space for discretionary spending to government is very, very limited, because there are clear indications that probably we need to keep spending higher on defense, salary and subsidy part, where we don't have much of space left. So I'll basically ask two questions from this part, which is that, is there any, how ready is India for potential next leg of crisis, given our debt to GDP is very high? And second, given that debt to GDP is very high, the capex piece is going to take a back seat. Even in last fiscal year, which is 21-22, government was not able to meet its total capital expenditure targets. So if that is the case, then how can both consumption piece and capex peaks can be a driver of growth over short to medium term?
Look, I mean, there will always be execution challenges, but incrementally, if you look at the last several years, government's actual capex expenditure, even if it has fallen short of the projections, has been on an uptrend. And yes, and to the extent that the government has budgeted for 7.5 lakh crores of capex, which includes 1 lakh crores of interest-free loan to the state governments. And if there are some shortfalls, which may be possible, but nonetheless, the trajectory in terms of actual spend is upwards, and that's important to keep in mind. And several state governments are also improving their quality of capex expenditure. So, I mean, in terms of the budget debt, so the debt dynamic is something that has deteriorated far more in several other countries. And as far as India is concerned, its response to the pandemic in the last couple of years has been one of gradual and calibrated fiscal intervention. So it hasn't overspent and overstretched itself. And much of the increase in the ratio has been due to the denominator shrinking in 2020-21, the GDP. So, and as long as nominal GDP growth lies above the nominal interest rate or its real counterpart, real GDP growth being higher than the interest rate, our debt sustainability is not in question at the moment. So it is going to be, it is very difficult to, in this situation, as the survey pointed out, when shocks are coming one after the other, it is very difficult to give you unhindered 3 to 5 year path. But what is important is that we remain opportunistic in terms of grabbing growth opportunities. For example, whether it is agricultural exports or whether it is services, IT services exports in the current environment, and also even 2021-22, because of the global rebound from the 2021 contraction, it also helped India's exports to scale $400 billion. So there has to be opportunistic attempts to capture growth dynamics in critical areas, and also carry forward the structural reforms that are needed. Much has been done in that area, from Gati Shakti dashboard to ending retrospective taxation to privatization, etc. And at the same time, continue to provide fiscal support in a targeted way. It is going to be a tightrope walk. That is what many governments around the world are facing. India is no exception. But our track record in the last couple of years or more has been that we are managing this tightrope walk quite competently.
Oh, absolutely. And, taking forward from that, I like, our audience would want to know, the chief economic advisor of this country, sir, we've heard so much about inflation. Is it structural? Is it transient? In your opening answer, you did say, India is doing better than other countries. But ahead of Friday's outcome of the Monetary Policy Committee meet of the RBI as well, our audience would love to know. So where are your views as far as inflation goes? It's dangerously reaching that 6% level. We've still not passed on and seen the full effect of the commodity price inflation as well.
No, I don't comment on monetary policy in public, so I wouldn't say anything about it. But yeah, the inflation outlook is challenging, and we'll all wait and see whether the RBI is going to make any revisions to its growth and inflation projections, because the April meeting is always an important one in terms of setting the tone for the entire financial year. And as the survey also acknowledged, given that the assumptions were made about the oil price being 70 to 75 in the survey, but not in the budget, and given that the average oil price we still don't know yet because the financial year has just barely started. If it turns out that the average price of crude oil is significantly above the assumptions made, naturally inflation will be flirting more in the will be flirting with the upper end of the 2 to 6% range rather than towards the lower end. And therefore, the upside risk to inflation is a phenomena that, once again, as I point out, is a global phenomenon. And there are many countries that are having inflation rates that they have not seen in the last 30, 40 years. Yes, we will have an inflation challenge, but that needs to be put in context of what the rest of the world is experiencing as well.
Well, I appreciate on your thoughts on regarding the monetary policy that you don't want to say on to anything. But as far as the advanced economic central bankers are concerned, they are clearly turning very hawkish at the time when the global growth have very serious headwinds. Even before this Russia-Ukraine situation arrived, Europe, there are clear signs that Europe is very closer, or it may already be in recession. US, at least the bond yield curve and the curvature are indicating that even US can slip into recession probably maybe 12 to 18 months down the line. China is slowing down. Now, which means that central bankers for the first time, they are testing markets or maybe testing economic activities by tightening at the time when the economic activity is slowing at a massive pace. Now, I'd like to hear what's your thought, how tenable it is, or are we getting, or all central bankers pushing this entire paradigm into some bit of stagflation scenario incrementally?
So I'm not sure entirely. I'm not sure I understand the question very well. Developed country central banks, particularly the United States Federal Reserve, has been very clearly signaling, at least in the last couple of weeks or so, that they would look through the supply shock and try to contain the inflation by being quite aggressive. And we have to wait and see what they do in the May and June meetings in terms of both the rate action and their balance sheet reduction or not. So, I mean, and other central, I mean, UK, as we all know, has been already raising interest rates. Australia has signaled a turn. ECB may be still reluctant to follow suit, and Japan hasn't yet. So there are multiple responses there. And the United States has been quite strong in signaling their intent to look past the stagnation aspect, but focus more on the inflation aspect. And I'm sure that the Reserve Bank of India will be cognizant of what is going on elsewhere and position itself accordingly.
Okay, let me just sneak one last question on the bond inclusion part of it, because we hear all sorts of stories, whether we are getting into it or not getting into it. So what's your stand incrementally, and especially the experience that we have seen in last 45 to 60 days? And as such, we have a liquidity situation at our hand that we are in very large liquidity surplus. So beyond the nitty-gritties, has there any change in the view, at least from your side, regarding the bond inclusion part of it by India sovereign?
No, I'm not aware of the developments on that front. So I don't have anything to add on that than what you know already.
Okay. If we have time, probably one more.
Just one last question, please, because somebody came.
Yeah, you have a hard stop, sir. We remember that.
Yeah. So, sir, last question is regarding that Indian current account deficit is now dangerously close to more like 3.5, and this is at least post 2008 and 2013 experience. The policymakers, they gave us a hint that this is kind of a red line from the policymakers. So, among the bad policy choices, do you think that in the current macro setup, probably the weaker rupee should be the choice of instrument? And if that is the case, why is that not being used, or it is being now actively considered given what's happening global front?
Again, currency policy rests with the Reserve Bank of India, so I'm not going to comment on that in public. And secondly, as to your point about current account deficit being 3.5% of GDP, that depends on your assumptions about the nominal GDP growth in India as well as the exchange rate. So, I mean, if you look at, even if you assume that the current account deficit in absolute dollar terms turns out to be $100 billion, and if indeed the Indian nominal GDP
speakers. All right. Now, before we have a very interesting speaker coming up next, but before that, we have a very interesting speaker coming up next, but before that, just come up to you in a second. Once it's up, you can share in your answer. Is it neutral? We will be waiting for you to quickly put in your answers, and I would love to share.
That you would see the US 10-year at around 2.6. You would expect around 7 on the inflation front, we would have expected that inflation, which was kind of and on the US Fed, I think the Fed has been more hawkish than anticipated. In the last policy, Powell indicated that he is willing to take faster rate hikes. Again, the key now target is inflation, which is the most important thing which US is targeting over and above growth. And as a result, the expectation of Fed hikes, rate hikes in this calendar year has gone up to as high as around 7 to 8 rate hikes in this calendar year, which means that you will see a faster normalization of the policy rate to the mean level of around 2.5%. And on the back of higher interest rates, expectation of higher interest rates, and the geopolitical risk, I mean, dollar has been a safe haven, and we have seen flight to safety, and dollar index, the DXY, has strengthened, which means there is some kind of a sell-off in the risk assets and poses some risk to the emerging market in terms of the flows. We have also seen some volatility in the currency across the world amongst this backdrop. And the big talk has been about the inverted yield curve, right, which is the 2-year bond yield, US 2-year and the 10-year difference has gone into negative territory, which foretells normally that you will see a global recession, and that has again been a cause of worry. But here again, let me highlight that this inversion yield curve has not been uniform across the yield curve. If you look at the US 2-year and the 3 months paper, there it is still not inverted. So while there are some probability of a recession, but we've seen that in the past also, okay, where the yield curve has inverted. There are 3 instances in the past where the Fed has managed to do a soft landing. And this time around also, I think looking at the fact that the US economic growth is still fairly strong, the job market is again doing very well. And on the US consumer side, I think the overall saving rates are still fairly high. So they should be able to tide this situation much better. And so our base case assumption is that growth will definitely slow down, but we are not really looking at a recession. I mean, that seems to be a low probability event. On this backdrop, we've seen the global growth estimates probably, I think, with the war in Ukraine still not really coming to an end, and the supply side disruptions. You could see the global growth probably shaving off by around 80 to 100 basis point in this calendar year. With the euro area is likely to be the hardest hit because there the sharp increase in the energy prices and the proximity of trade with euro and the Russia would have a larger impact. And consequently, earnings are also likely to get downgraded. So for S&P 500, compared to an expected earnings growth of around 8% in this calendar year, the earnings could probably grow at around 5%, so a 3% downgrade to earnings. So what we've seen is that in this backdrop, clearly things have turned at the margin slightly negative. Even on India front, India's GDP growth, which was kind of recovering well post-COVID, we have seen a good recovery, though we are still in the trend line. I think India is still below its trend growth, okay, which was there pre-COVID. US is now well above the trend line growth, but clearly India was coming back slowly and steadily. We've seen that the third wave which came in, we are out of that, and the recovery is panning out well. Because of the current situation, again, India also be expecting the growth rate. We were early expecting around 9.5% GDP growth in this fiscal year. That could probably slow down to around 8.5% or so. But I think India is structurally now set for growth, which we expect it to, over the next 2 to 3 years, go back to its potential growth trajectory, which is around 6.5%. And the reason for that is that the multiple drivers for India GDP growth, both investments, consumption, and exports, all these three levers, we expect that to do better, despite the near-term setback what we've seen. So if you look on the investment side, why we are so positive? I mean, India, in the last 6 years, we've seen investment to GDP has come down significantly, but there are signs of early revival in the whole investment cycle. I mean, government spend continues to remain fairly strong, and in this budget also there has been a big thrust on the infrastructure spending. The housing market in India, after a gap of almost 7 years, is showing signs of revival, again, thanks to the affordability which has gone up, the low interest rates, and the push by the various state governments in terms of cutting the stamp duty has given a boost to the real estate sector, which we think will start to revive. And there is genuine demand for real estate in India at a right price. And overall, private sector capex, we've seen early green shoots of private sector capex pick up in a few sectors like the metals, cement, and textile sector. And here again, I think the overall foundation for capex revival is in place because the corporate balance sheets are now fairly delevered. Corporate India in the last 2 years has really taken the increase in profitability to really delever the balance sheets. And as demand recovers, they are in a good position to really start investing. The bank balance sheets are also fairly strong to start lending. So, and in India, I think the government focus on manufacturing and the PLI scheme, which has been introduced, has seen good traction. We've seen many companies, domestic as well as foreign companies, announcing plans to set up manufacturing base over here to take advantage of the PLI benefits. So investments slowly and steadily, I think, should pick up. And we talked earlier also in the Economic Advisor being positive on the whole capex recovery. Exports have been doing well on the back of the strong US recovery, what we've seen. And going forward, while you could see some slowdown in the global growth, but I think India is likely to still continue to do relatively better, I would say, because A, we are gaining market share. I think the whole China plus policy which is going on, India has been a major beneficiary of that, especially in sectors like textiles, specialty chemicals, in pharmaceutical API. And that will continue to drive exports at a fairly good clip is what we can assume going forward. Also, IT exports, which is more services exports, have shown a very strong trend during the pandemic. I think the full focus on digitization, India is very well placed to capture that. And the order inflows for the IT companies has been fairly strong. And that looks to be likely to grow at around 12 to 13% even in this fiscal year. The third pillar of India GDP is consumption, which has been a weak spot recently because of the COVID. And also the rural recovery has been fairly slow. But here again, I think the overall structural drivers for India consumption to pick up are in place with the favorable demographics, the Gen Z population, which is willing to spend, and the per capita income at an inflection point where discretionary consumption will start to pick up. I think discretionary consumption as a percentage of total consumption which has already reached around 24% or so, is likely to go up to around 40% by 530. And what we've seen is that overall in India, the trends with the whole digitization, okay, which has happened, and the adoption of digital in the last 1.5 years, a lot of consumers in interior towns and villages of India are also able to really, which are also have aspirations to able to reach out, and we've seen strong revival on the retail side. And another interesting phenomenon which we've seen is India is, I think, the emergence of the whole startup ecosystem in the last couple of years. There's a huge amount of funding which has come into the startup ecosystem, and that is also creating new jobs in the organized sector, which should help to drive consumption. Even the IT sector has been a big employer this year. IT companies will hire almost like 5 lakh new engineers, which would again bode well for consumer, especially discretionary spend. So while consumption will still be slow, and because of the high inflation, okay, in the short term, I think you will see, but I think slowly and steadily, I think we see a revival of that coming through. And as you saw, and luckily for India, I think the whole COVID wave, we have passed through that. We had the least number of cases, whereas across the world, we're seeing in China and other places, again, a rise in COVID cases. And as a result, the opening of the economy in the last couple of months has been fairly strong. And I think that should continue. It's also reflected in the high frequency indicators, which are showing good traction. If you look at the latest GST numbers, which came in, was an all-time high at around 1.5 lakh crores. Even the toll collections at the tollways is also at an all-time high, which shows that there is mobility is again back to its pre-COVID level. And the manufacturing PMI is also showing a healthy trend. While let me caution here that some of these trends could get impacted in the short term because of the supply side constraint, but I think clearly we are on a path of steady recovery is what it foretells. I think while the COVID has, the last 2-3 months, the outlook because of the high inflation and the Russia-Ukraine crisis has been a cause of concern, but I think there is a silver lining over here, at least for India, I would say, is that on the food price, the whole rural India, which has been going through a pain point in the last 1 year because of the second wave of COVID impacted rural India much bigger. And the government really support last year, the budget was not much for rural India. So we've seen rural consumption slow down, which has been reflected by the commentary from the two-wheelers industry, and also for the consumer staple companies have been commenting on that. But I think there is a ray of hope over here. I think we expect rural consumption or the rural India to do well next year because, as you know, food prices have gone up, and India, luckily, except for oilseeds and pulses, is self-sufficient in food, and we are in fact exporter of wheat. So the higher food prices and consequently higher MSP prices also would mean that the farm incomes, okay, next year in the Rabi and the Kharif crop should be good. Cotton prices also in the cash crop have gone up by around 50%, so that should also help. And the good thing is that the reservoir levels have been fairly good, and monsoon indication is also normal. So I think if rural India is able to recover and come back, I think that will again aid India's recovery and the consumption going forward. India again has been benefited by the to some extent by the anti-China sentiments, and initially it was the US trade wars, but post the Russia-Ukraine crisis, I think China, with his more support to Russia, is likely to be de-alienated by the foreign world, and increasingly investors are looking to shift out of China, while other Southeast Asia, Mexico have been the favored destination, but India is also now getting investments. And considering the fact that we've seen big reforms in India in the last many years, a lot of the infrastructure bottlenecks which were there, now global investors to really look at India as an alternative. And India also has a large domestic base alternative. And India also has a large domestic base to really cater to. So it becomes a natural choice for somebody who wants to set up a large manufacturing base in India. So some of these things are the silver linings amidst the current backdrop, okay, which looks fairly gloomy and negative. So I think there are structural drivers in place for India is what the limited point I wanted to make. And even on the macroeconomic stability, I think India is now being able to do much better in terms to withstand any external shocks. And we've seen that this time around compared to FY13 when we had the taper tantrum, and when there was a commodity shock and oil prices shot up. This time around, if you look at, we are in a much better situation. While the CAD this year, because of the higher crude oil prices, would be around 3% or so. But if you look at short-term external debt to GDP, we are much better placed than what we were in the past. And that has been, I think, good. I think India has never really borrowed too much of external debt. And that is helping during this period. Also, our forex reserves have been fairly comfortable. We have accrued that in the last couple of years. And we are setting on almost like 1 year of import cover, which is also comfortable, much better than what that was in the past. And inflation, if you look at earlier, okay, when we had such kind of situation was much higher. This time around, India CPI inflation is much controlled at this point in time. And I think and that has also been tested. I think we've seen this time around, even with oil shooting at around $110, $120, the rupee has been fairly stable. If you look at in the earlier crisis, whether it was the GFC or the taper tantrum, we have seen a sharp depreciation and the volatility in the rupee. But this time around, during this period, the rupee has depreciated by just around 2.6%, and the volatility has been the least. I mean, that shows India's resilience, and India has really come of age, and especially for an emerging market to show that kind of a resilience. I think that gives a lot of confidence even for foreign investors who want to look at India from a long-term perspective. Coming back, how does that really foretell for corporate India? So if you look at corporate India, I mean, in the last 2 years, despite the fact that the overall GDP growth was negative because of the COVID crisis, but I think this is the time actually where we've seen corporate earnings growth in the period from FY19 till FY22 has actually been higher than the long-term average what we've seen in the last 10 years, right? Around 15% or so. And we expect while this year in FY23, we were early expecting the Nifty earnings growth to be around 17%. We could see some 3-4% downgrades to that. But still, we are looking at a fairly strong earnings growth in the next 3 years, driven by, again, as I said, domestic recovery. The infrastructure sector, the capital goods sector is likely to see a strong revival. So I think overall corporate earnings growth over the next 3 years, we think can still grow at around 13 to 15%. There is enough room for corporate profits to reflate because in the last 5, 7, 8 years, we've seen corporate profits to GDP had come down significantly. And with various sectors, domestic sectors now firing, earnings growth should be fairly decent. And valuations, where they stand at this point, that has been, the markets had rallied ahead of the fundamentals because of the large amount of liquidity push what we've seen in the market, and the multiples are trending higher. Now with earnings catching up and growing strong and a slight correction, valuations are now slightly above the long-term average. If you look at in terms of price to earnings multiple, on a price to book value multiple, it will be around 8-10% higher. So the valuations are not cheap. It's slightly expensive. And to that extent, I think as the normalization happens in the policy environment, I think you will see P multiples would also normalize over the medium term, and that's what our view is. Overall, on the liquidity side, FI flows have been large sellers in the market in the last 6 months. We've seen almost $18 billion of FI outflows since October. Again, that is on the backdrop of the global situation, what we've seen, and also the fact that Indian markets were relatively expensive, looking expensive. But I think the good news is that the domestic in the steady. Here, I would say that with the large amount of selling, what we've seen on the foreign flow already, has come down. And we haven't seen these kind of large outflows in a calendar year. So I think once the dust settles down on the global front and things normalize, we would see FIs again coming back, because I think India is the market which still really holds structural long-term growth story. And also within emerging markets, what has happened is that if you look at Russia, which is now totally out and not investable, China, which looks attractive, but China has seen a lot of volatility, and with the Chinese policy measures, which have been impacting growth and the whole meltdown in the China tech space, investors not really comfortable looking at China, even though valuations are attractive. And other markets like Brazil, which is more commodity linked and can't be looked at from a really long-term perspective. So India really default becomes a natural choice if somebody has to really take a longer-term view. So we would expect the FIs flows to, and already we have seen in the last couple of weeks that the intensity of FI selling has slowed down. And domestic flows, I think I don't see any reason for that to really come down. And large amount of flows have been coming in from the SIP route. And the good news is that India, we've seen the penetration of the flows has now increased. There are a lot of new investors which have come into the market in the last 2 years. That has been also reflected in the secondary market, in the opening of the demat accounts, which we have seen. And the ownership of equities of Indians is still very low. I mean, it's gone up from, say, around 3% of your savings to around 5%, but it's still way low. And I think looking at the alternatives, I think you would see equities will continue to see the flows what we have seen in the last 1 year. So overall, on the marks, to summarize the market outlook, I would say that the recent uncertainty, which has because of the war-like scenario, the high inflation, sharp expected increase in interest rates has taken center stage, and it is likely to lead to more volatility in the markets as we have seen in the recent times, and that is likely to continue. Also, the global overall growth outlook would see some moderation and some downgrades. Even earnings could see downgrades in this calendar year. But I think from India perspective, I would say that the structural drivers are very much in place. We could see some normalization, in terms of the overall valuation multiples going forward. But I think with the 3 pillars of India's GDP growth improving going forward, we think that corporate India earnings growth of around 13 to 15% in the next 3 years is quite possible. And even if we assume some derating of multiples, I think market returns can be a tad lower than the earnings growth going forward. So that still makes equity as a reasonably good asset class to invest going forward. And I would say for investors to really stay invested, there is some amount of risk in the shorter term. One can expect some correction from here. We've already seen some around 12-13% correction in the last 3 months. But I think this correction should be used an opportunity really to dip into to really benefit from the long-term structural story. I would like to highlight here that this year the market is going to be much more discerning and is going to price in risk much better. You will not see everything going up like we saw in the last 2 years. Companies where earnings growth and visibility is stronger, I think they will do well. And it's in that sense will be a more stock pickers market. Overall market returns in this is, I think one should look at this year as a kind of a pit stop in the longer race what we are into. And markets will probably consolidate this year. But the long-term returns still look fairly strong. In terms of where to invest in this current environment, on the equity side, I would say that large cap would continue to be favored at this point in time. So we would recommend around 25-30% allocation in the large cap funds. Current uncertainty we've seen during the crisis also, the large cap companies have been able to manage their margins and overall profitability much better, and that will continue. But a larger allocation should be towards a diversified fund which can play across the large, mid, and small cap spectrum and do that well. So 35 to 40% in a flexi diversified fund, where we have funds like a flexi cap fund, the large and the equity advantage fund, which is a large and mid cap fund, the multi cap fund, and even our recently launched ESG fund, where we have seen the world is now really recognizing ESG as a big theme, and companies which are really following that are getting rewarded. Mid and small cap space, we still like it from a longer term perspective, given the fact that a lot of these companies are dependent on domestic recovery, and where we are fairly positive from a next 2 to 3 year perspective. And one can continue to make the target allocation of around 15-20% towards a mid cap fund. And in thematic categories, we would recommend the banking and financial services funds. I think the whole banking sector is likely to benefit from the recovery in the economy. The credit growth is likely to pick up, and with the whole NPA cycle kind of bottoming out, we should see a very good growth in the banking and financial services side. And apart from that, the whole consumption theme, which is a long-term and structural nature, and as India opens up and as the penetration increases, that will be a good structural story to play, and that can be played through our Gen Next fund. Also, we are seeing a lot of new companies coming in the IPO market in the consumer space. These are good niche companies, and one can participate that through this fund. And finally, the whole digital theme, which has played out well in the last 2 years, last 3 years, we expect that to continue. It offers good visibility of growth, and it's a trend, I think, which will continue to do well going forward. Apart from that, I think in the current uncertainty for investors who wanted to come into the market and decide how to do it, the Balanced Advantage Fund would be a great fund to really come into. And also our Asset Allocation Fund, which you will hear more about in tomorrow's session. I think these are the two funds which, especially for a new first-time investor or investors who are looking to really look at, besides investing into debt and looking at slightly better returns but lower volatility, I mean, these are the funds which definitely one can look at this point in time. And the larger themes which look to be of interest to us, we shared this during our annual outlook, which remains the same. The banks, the banking and financial services sector, which I talked about earlier, valuations there are still reasonable compared to the long-term averages, and could be a good play to play the whole India growth story. Real estate sector is looking to revive. We have seen the whole low interest rates, affordability kind of tailwind which are falling in place. The inventory which was there in the whole system is also now coming down. We have seen good absorption of that. And I think one should see steady recovery in the real estate. We've seen a good amount of consolidation also for the organized player, which should benefit. Consumer discretionary, especially the small ticket consumer discretionary, as a structural theme to play, I think, for India for the next decade, that continues to hold true. And the whole manufacturing, the sector and the private sector capex recovery is a theme which I think will play out over the next 3 to 4 years. And the digital transformation. These are the 5 themes which will continue to do well in the coming years. Finally, I think while equity would still be an asset class or a longer term which gives good returns, but as we enter into a period with high volatility, I think it's important to really focus on the asset allocation and have the right asset allocation to reduce the volatility. Amongst the various asset classes, what is our outlook over here? So gold has, given not too great return in the recent, only in the last couple of months, we have seen gold prices go up. But I think amongst the current uncertainty as a safe haven and in a period of higher inflation, I think gold could still do well and can be considered as a part of the asset allocation. One can expect high single-digit returns over the next 1 year. Bonds have not done that well in the recent past, and looking at the interest rates are still low, and we are in a phase where we will see interest rates move up. Bond prices will remain under pressure. So the next 1 year, I think the returns there would be muted. I think a year down the line, I think once interest rates normalize, I think one can look at the debt funds. Finally, property prices have, the last 7 years, have been fairly flattish. We've seen revival over there, some increase in property prices. And as demand picks up, I think property returns could be in the mid single digits is what we could expect. Equities, as I mentioned earlier, this year would be a year of consolidation. Don't expect great returns, but over the next 3 years, I think earnings growth in the 13 to 15%, and returns could be slightly lower than that. So I think the current high inflationary environment, I think equity still remains the asset class of choice from a longer term perspective. And one should not really lose sight of that despite the near term volatility. So with this, I would halt here, and I think, Avni, we can go ahead with the Q&A.
Absolutely. Thank you so much, Mahesh. It's been very insightful. You've covered pretty much every topic. So there's a lot that I would like to discuss as well. So let me begin by just talking about the overall market then, Mahesh. You know, we're close to all-time highs. And the last time we were at these levels, you had crude at close to 74. There was no war in the world. The Fed was not supposed to be hawkish. But now the scenario has completely reversed. It's been the complete opposite on pretty much all of these pointers. So what do you think explains the euphoria in the markets?
Yeah, so as I explained earlier, I mean, clearly things have turned a bit adverse than what they were 3 months back. And I think markets are still looking to look beyond, the near term. And while there are talks about growth slowing down, but I think the overall longer term, especially for India, I would say, I think the long term growth trajectory potential for India is something which is investors are probably looking at. And while we have seen that liquidity and this thing has kind of slowed down, but I think the alternatives are not really much. And in a period of slightly higher inflation, I think equities tend to do well. So lack of alternatives of where to invest, and the fact that the current situation, what we have seen, if that de-escalates, especially the war situation, then you could see things normalizing very fast on the high inflation and the commodity prices which have gone up. So I think that is what is keeping the markets where they are and being so resilient. But that doesn't mean that you can't see a correction. I think one has to be cautious. I think we are cautious while we are positive from a medium to long term perspective, but near term we are very cautious at these levels, and investors should expect some correction. When to what extent, very difficult to foretell.
Fair enough. And I want to just take off about the earnings. You flagged off that, there is that commodity price inflation. There will be earnings downgrades, but still you remain fairly positive on earnings. So over the long term, of course. So given the fact that the kind of commentary that we've been getting from some companies, they are indicating that the commodity price inflation is real. It will eat into margins. What is it that you believe we are likely to see in terms of earnings growth?
Yeah, so I think you will see a few sectors and companies where the impact on inflation has been much higher. And in the current environment, it's not possible to pass on that full price increases, right, to the end consumer. It has to be taken in steps. So the next couple of quarters, you would see that impact, especially in the auto sector, probably even in the consumer, staple consumer durables space, where the impact could be larger. But overall on the earnings front, I think there are a few sectors, whether it is the energy sector, the commodity sector, where probably, the impact will be slightly positive. Even large sectors like banking, for example, we don't see any major impact on earnings. Overall credit growth, in fact, a slightly inflationary environment means that the working capital requirements will be higher. So you would see a better credit growth over there. The yield curve in India is still not inverted, it is still steep. So that's good for the banking sector. So banks' profit should be fairly good, and we're not seeing much stress on the retail balance sheet or the corporate balance sheet. So given that, I would say there are a few sectors, where there could be downgrades, but on balance, if you look at on an aggregate basis, we are not really seeing, except for a 3-4% downgrade, we won't see too much of an impact over there. And as see, India, the rate of recovery has been very slow and gradual, and the opening up, which has only just started, to play out, as that gathers momentum, you would see the top line growth, which was a big challenge. I think that will also slowly start to improve.
Mahesh, you did touch upon the theme of digitization in your presentation, and it's ever so crucial. Look where we are today. We're doing an entire conference via Zoom, everyone sitting remotely. Let's understand some of these new age tech companies that thrive on this theme of digitization, and how you expect investors, especially a lot of these new age investors, to approach this theme.
So I think India has also seen all these new age technology companies. They have been thriving in the private space. We have seen some listings coming in recently, but recently, because of the global sell-off, we have seen a sharp correction and volatility in these stocks. But I think they are here to stay, and the digital transformation, what we've seen, is across the board. India has also adopted digital much faster, and I think the penetration of mobile data in India has really helped that, and during the COVID, we have seen that adoption. So I think there is disruption, which is likely to happen across sectors, and the existing incumbents which are able to adopt digital fast and quickly, I think will continue to do well and survive. And some of the new age technology companies will gain market share. I think here, by investing in this space, what we really look at is companies which have really established proper model in terms of profitability, and have the unit economics in place. So while they might currently be making losses because they're investing for growth, but the road to profitability is in place. I think such companies, we definitely will look at from a long-term perspective. And also companies which have already established leadership in their segment, because this is a space where companies will continue to fight and burn money. But companies which have established leadership, one can be pretty sure, and have got capital, enough capital, I think they will they'll survive and continue to grow. So I think it's still early days. There'll be a lot of volatility over here. A few companies will fail to really meet the expectations. So we are really approaching the space in a kind of dipping into that space, not taking a very large exposure, trying to understand and see which companies, as we track their performance, which could continue to gain market share, because the opportunity size is big, where the target markets are very large. And as we work along with these companies, and as we gain confidence, we would increase exposure in some of these new age technology companies. And as we gain confidence, we would increase exposure in some of these new age technology companies.
Okay, that's a word coming in on new age tech. And incidentally, today it was in focus when we saw it at the other end, where Zomato and Swiggy were facing some outages, but that's part of life, I guess, Mahesh. I also wanted to talk about your outlook when it comes to the liquidity situation. You did say that when the dust settles, in particular when it comes to the geopolitical tension, that we will see FIIs returning to the market. So you're confident that India, in terms of the entire emerging market basket, still has a favorable place when it comes to FIIs?
Yeah, I think if you look at in the last 15 years, right, there only, global financial crisis. After that, we've seen a calendar year where FII flows have been negative. Last 6 months, we have seen large amount of outflows, again driven by what's happening globally and the concern. I mean, the outflow from the emerging markets. But I think India clearly, I think, has shown, I think, especially during this turbulent time, okay, has shown a lot of resilience on the macroeconomic side, and also from the stability overall in terms of the currency, which has been fairly stable. And I think in the emerging markets, as I mentioned earlier, I mean, China, which is a large part of that, right? It's almost 30% of in the benchmark, more than 30%, is a market which has been fairly shaky. Overall economic growth in China is likely to slow down. They're struggling over there in the property market. And given the policy flip-flops over there, I think the confidence for investors is not like much. So India by default becomes a market which one would want to really play from a long-term structural perspective where the drivers are in place. Even in terms of growth, I think amongst the large economies, I think India would still be the fastest growing economy. And even in corporate India, I think India has got much more diversity. It's not only commodity focus or focus only on the financials. So I think given that diversity and the structure, I think I have no doubt that foreign investors, okay, will come in, and India will remain an expensive market, right? Because of better growth dynamics. India's multiples, okay, or the premium which is there compared to the other emerging markets, okay, that will continue.
I want to also take some questions that our viewers and participants are sending in to us. And it's actually two questions which have come on the same sector, and one sector that's been hot off late, owing to the consolidation that we've seen with the HDFC twins. There's two questions on the overall banking sector. They say, Josephine asked that it's taken a huge hit. Do you think that we will see a turnaround with the current economy? And what's your outlook as well, Mahesh, on the big news?
The banking sector, if you look at the current numbers, I think we are seeing credit growth starting to pick up, which is good news. Last year, okay, we had seen mid-single digit kind of growth. And overall on the asset quality also, after the COVID crisis, we've seen now things starting to improve. Hopefully we are out of the lockdowns, so one should not see any major challenges over there. And overall bank profitability, I think in terms of earnings growth also, if you look at next year, are showing a healthy trend over there. So I think the banking sector by and large should do well. Within that, banks which are have very well capitalized, I would say, and are also focusing on digital, because we are going to see disruptions over there from the new fintech companies which are emerging. Still early days, but banks which are really equipping themselves really to not only enable themselves for having a secure digital future, but also giving competition to the fintechs, I think will continue to gain market share over there. So I think, and again in the valuations, if you look at in the banking sector, I think we've seen some underperformance recently because of the global crisis. Okay, whenever there is a risk off, we see the banking sector get sold off. So the valuations are fairly reasonable compared to the long-term averages. So the risk reward there looks fairly good for us. And I think, yeah, I mean, we have a positive view on the sector, and we expect it to do well across this cycle.
Thumbs up there coming in on the banking sector. I'm going to take on board another question then from one of our viewers. Mr. Surendran says that with the influx of new investors chasing leading names, don't you think that these so-called giant names are now highly valued? How do you justify the return on investment? Mahesh.
Again, that's a very relative question. I think it's stock specific. I think the larger cap companies or the leading companies which are strong in each segments, and they will continue to find favor with investors. But what we've seen is that even during the last 2 years, the larger and the bigger companies have bigger and bigger, right? And that trend, I think, will continue. especially during times of crisis, we see there is a more consolidation which happens in the industry, and the bigger and the larger companies continue to gain from that. So they will be expensive. Obviously, one has to really look at in terms of where the risk reward is, in terms of the growth and the valuations. But I think the leaders in this space will continue to command a premium, is what I think. And one has to really look at really in terms of where the valuations are compared to their historical levels, and then take a call on these names. But I think it's better to be in this current market environment where there is uncertainty, at least in the near term. It's better to be in companies where there is much more certainty in terms of the earnings, and that's where I think some of the larger names, I think the leaders, I think, would offer that.
Earnings visibility is crucial. Mahesh, given that the market price is a function of EPS and PE, we've seen the PE rating that has taken place. EPS, if at all, because of margins, inflation, and even demand pressure could come under pressure. What is the outlook in terms of returns that we're expecting? If we're not going to see EPS go higher and PE come down, how do you expect the return metric to play out?
So as we mentioned earlier also in Outlook, that this year, of multiples because of the headwinds, what we are seeing, rising interest rates and higher inflation, and also lower liquidity, global liquidity, I would say. Earnings growth, I think, would still be fairly fine in the double digits. So as a result of that, I think because of the normalization in this year, I think the returns will be fairly muted. I think, as I said, this is a year for consolidation. Don't expect any great returns. But I think as the earnings trajectory continues to play out over the coming next 2 to 3 years, I think that's where the market returns would be. And that's why we said that the overall market returns will be slightly below the earnings growth if I take a 3-year view.
Mahesh, it's always been a pleasure interacting with you. Thank you for being so candid and elaborating your outlook on the markets, the CapEx theme, the macros, as well as individual sectors. Thank you.
Thank you.
Thank you so much, Mr. Patil and Avan, for that. Great insights we got from that session. As you know, we are requesting you, the pop-up would have come up. Do rate our speakers, our sessions. Just let us know your thoughts on that. Before we move on, as you know, just before we went into the earlier session, I did ask you for a poll, which was what was your outlook for the Indian economy for FY23, whether it's bullish, bearish, or neutral. Well, the answers are out with me. It's very, I don't think it's that shocking or surprising, because 57% of you have said that it is bullish, that your outlook for the Indian economy for this financial year is bullish. 6% have said bearish, and 37% have said neutral. So that's a good gauge, I guess, of what everybody is thinking. Now, as always, we would love hearing from you. We're trying to take more and more questions, so keep your questions coming in through the question tab at the bottom of your screen. Also, please keep the interaction on with us. Tweet using the hashtag Voyage2022, and do remember to tag us at ABSLMF. We've got prizes for the smartest Twitterati, for the person who answers the polls the quickest, for the people that are sending in the good questions, the most number of relevant questions. And also, we would love for you to tweet with your thoughts on why you love Voyage 2022. So use the hashtag Voyage 2022 and do tweet with that. Okay, time for our next session. Our next speaker is a well-known expert of emerging markets. This is the first time he's gracing the platform of Voyage, and like every session of his, this one too has generated a lot of interest among the audience and a lot of expectation. Please welcome Mark Mobius, partner of Mobius Capital Partners, and he's in conversation with ET Now's managing editor, Nikunj Dalmia.
Mark needs no introduction whatsoever. He's got years and years of understanding of market cycles. He has a wonderful insight on how emerging markets evolve, and Mark was one amongst the first emerging market investor the world has seen. He started investing in emerging markets, I think, in way back in 1980s. He's a true blue value investor, and over the years I've interacted with Mark on various forums. He's always been a big India bull. I understand that his largest portfolio exposure is in India, and you will try and understand that what he makes of his India exposure and where, according to him, the world is headed. Mark, on behalf of everybody from ET Now, the Birla Voyage team, and millions of attendees, a very warm welcome and thank you for joining us.
Thank you for having me. It's a pleasure.
Mark, if I look at global equity markets, we are not far away from an all-time high. We hit all-time high in late December and early Jan, at least for India. And when we were at all-time high last time, there was no war. Oil was under 100. Fed was calling inflation transitory, and there was no energy shock. The four factors which I mentioned will change the medium and the long-term picture for earnings and for equity as an asset class. Yet markets have managed to climb the wall of worry. My concern is why?
Well, at the end of the day, I think people intuitively understand that with rising prices, which eventually are going to come, if you're printing money at the rate that governments around the world, particularly the US government, has been printing, you know that the currency is going to be devalued. And with devaluation of currencies, you have rising prices. And intuitively, people realize that in order to save themselves from these rising prices, they have to be investing in a area where the prices will rise with inflation. And equities are the best. Because if you invest in equities in companies that have pricing power, that can raise prices in line with the increase in the prices of goods and services, then they're going to be in very good shape. So that's really why you see this continuously rise in indices around the world. It's very interesting. If you go back 10, 20, 30 years, you can see that there's been a continuous rise, of course, with corrections along the way, of equity prices, simply because you are seeing this devaluation of currencies. And with that, you have rising prices of not only commodities, but also stocks.
So, Mark, for an equity investor, looking at the way how interest rates are likely to go higher and there is a margin of shock, isn't there a fear of earnings downgrade and demand getting challenged? And if that is the scenario, which is the obvious scenario looking at where inflation is headed, don't you think that will have an impact on equity in general as an asset class?
Well, the interesting thing, if you look at pricing power of companies, why are they able to raise prices? Well, if they're raising prices, they've got to have consumers. And the reality is that the consumers are there. Why are the consumers there? Because wages are going up. If you look at the United States right now, you'll see that wages are going up, unemployment is going down, and of course that means that prices can be raised by companies with pricing power. So it's really interesting to realize that at the end of the day, along with the rise of commodity prices, rise of consumer prices, wages are also rising.
Mark, do you think India is in a very unique and a special situation? China has got their own set of problems. Inflation in other emerging markets like Turkey is at an historic high. There are serious challenges in Russia that makes that market uninvestable if you're a foreign allocator. Do you think India, in a sense, even though expensive, becomes the only choice of preference, and that will ensure that the premium in India or the premium in Indian equities will remain elevated?
Yes, I believe India, of course, is in a very unique place. If you just look at the country itself, the population age average is what, 26? For China, it's 36 or something like that. So you have a very young population, which means you have very productive and growing demands and factories and companies that can be more productive with a young workforce. That's number one. Number two is you've got a government that's bent on reform, on changing the mindset of the state governments around the country and of improving the lives of people through technology. And the emphasis on technology by the government is quite a unique thing. It's not many countries in the world that have emphasized technology in order to improve the lives of people. So, yes, I would say that India is in a very unique place.
Mark, what do you make of the global headline, which in a sense bothered every large and long-term investor last week, which was that the global bond yields have inverted, and historically when that has happened, that has led to recession?
Oh yeah, the poor bondholders are in trouble because with rising interest rates, bond prices, of course, are going to crash if you're in fixed income bonds. But even if you're variable interest bonds, as you know, variable interest bonds don't adjust so quickly. So you can be in a very bad place when interest rates are rising. But you must remember, that's one thing. Equity prices are a completely different thing. Very often the headlines confuse these two things. They say, oh, the markets are crashing. Well, they're probably referring to the bond market, not the equity market. So you've got to make a clear distinction between these two things.
Mark, last time when we interacted with you, you indicated that India was one of your largest exposure and you had 3 holdings in India. Is that constant? Have you altered that? Have you changed that?
No, we haven't changed it. We found incredible companies and we're just hanging on to those companies. No reason for change. If you find a good company, that's one of the things that's very important to remember, that, you know, you must make your selection of companies in which you want to invest very carefully, take your time, do the study. But once you've done that and satisfied, you stay with those companies, regardless of what the changes in prices are.
Mark, at a global level, given that Indian markets have done well and we've outperformed, and if you compare India with China, Chinese markets are down and out, and some investors are calling them cheap. Are you tempted to go back to China? Are you allocating fresh money to India, or are you looking at going back to China?
We're looking at China. We constantly look at China. It's a big market, as you know, and it can't be ignored. But our preference has been for India recently because of the incredible changes that are taking place in the country and the path on which the country is embarked. But as you know, China's been hit with a lot of problems. They have a big debt problem with property companies. They have problems with concerns about their aid to Russia, which could involve sanctions by the West. Very unlikely, but it's possible and something that people think about. And more importantly, at the end of the day, the reforms instituted by the government to bring about a more level playing field, let's put it that way, in the market has resulted in downgrades by some of the biggest companies. And that has resulted in a downgrade of the index, the China index. That in turn has affected the emerging markets index, since China represents about 30% of the index. So all of these factors have been quite negative for China, but I believe they will pull out of that. As you know, interest rates in China are not going up, they're going down, and they should be able to pull out of this problem. But we cannot ignore China. We want to continue looking at it, but as I said, preference now is for India.
Mark, so you have three stocks like you mentioned in your India portfolio. When will you make that five if you like India so much?
Well, the problem with the index is that it includes a lot of problems because the index is focused on the large liquid companies, and not all the large liquid companies are good companies. Are not necessarily the best performing in terms of management, in terms of ESG. As you know, we look at the environmental, social governance, and also cultural standards of companies. So it's not a good idea, we believe, to invest in indexing. We're better off being an active investor, looking at companies individually and making decisions on that basis. And it's paid off for us, by the way, because those of our colleagues who've been following the index were hurt badly with the situation in Russia. Russia represented about 6% of the index. And of course, immediately overnight, they lost 6% of their portfolio. So indexing can be very dangerous.
So Mark, as we look into future, to your mind, which is the moving variable?
The moving variable is the pace of technology adoption, I would say. As you know, with 5G, with faster chips, with all kinds of improvements in software, the technological revolution is right on top of us. And those companies that are not able to adopt new technologies to improve performance and profitability are going to be in trouble. So that is really the variable we want to look at. And I'm not just talking about software companies or companies that produce semiconductors or anything like that. I'm not talking about that. I'm talking about any company, whether it be in mining and consumer goods or in anything. If they're not adopting technology to improve their performance, they will be in trouble.
Mark, you've argued historically that ESG is the way world would migrate now. But given that ESG also is causing greenflation, and just for the benefit of our attendees here, greenflation is getting, greenflation means that companies are not able to scale up capacity because of environmental concerns. With so much of inflation, which is now really having an impact on everyone's life, and it is becoming more like a political issue, do you think there could be a dilution on ESG front in order to control inflation?
Yeah, there is a talk about that. And of course, India and China would be good examples of that. As you know, both countries rely very heavily on coal, which, as you know, is also very polluting. And it's extremely difficult for them to give up coal because not only does it represent such a large part of the power generation, but also because it's cheap. It's cheaper than other forms. So the movement towards cleaner energy has been inhibited by these problems. However, we're finding now that some of the renewables, wind, solar, etc., are becoming cheaper and cheaper so that they can compete with cheap coal. And that's one of the abilities for us to be able to get out of this conundrum. Nevertheless, at times of stress, like we're seeing now where prices are rising, there is a tendency to say, look, I don't care about the environment. I need my power. But that will pass. I believe that the governments around the world are recognizing that there are also costs to a bad environment. If you look at the medical costs, for example, polluting air results in lung diseases and all kinds of problems. So governments are beginning to look at this and do some triage to evaluate exactly what is the cost of a bad environment. And that's true of a company at the company level. The reason why we're interested in ESG is not because it's a nice thing, but because it makes sense in terms of reducing risk. If you look at the environmental factors, the social factors, governance factors, and also the cultural factors, and look at them closely, you find that they all contain ways to reduce risk to the company. So that's really the key, and one of the kinds of ways that we're able to have a win-win kind of a situation with these companies.
Mark, so let's talk about the market cycle. I mean, you've got years and years of understanding. They always say, and since you were associated with Templeton Mutual Funds at some point in time, that there's nothing called different. Same thing keeps on repeating again and again. So where do you think this bull market cycle is? Because a bull market will start with disbelief. It will grow on skepticism. Then there would be maturity and participation, and ultimately it would be euphoria and bust. Where are we in the market cycle?
That's a very good way of putting it. And as you know, the point of euphoria is not here yet, that's for sure. We're not in a period of great euphoria. We may get there sometime, but we're not there yet. And that leads me to believe, and should lead all of us to believe, that we're not at the peak of the bull market. Also, if you look at the timing, see, it's been about 2 years now that we're in a bull market, right? Usually these bull markets last for at least 3 years. The good news is that when the crash comes, it will be very sudden and it will not last very long. You have a crash, it comes down rapidly, does not last, the downturn doesn't last more than, let's say, half a year, and then the new bull market begins. And of course, those people that are able to get at the bottom can make a lot of money.
So Mark, do you plan to ride the great Indian bull market for next 2 to 3 years?
Yeah, I believe so. You're not in a euphoric mood yet, that's for sure. And I think there's still room to go.
Would you be interested in the LIC IPO, Mark?
IPOs, as you know, have had some difficulties, not only in India, but in other parts of the world. But the move by the Indian government to privatize more and more of the state enterprises is excellent. It's a wonderful move, and it will bring great benefits to India, not only because of the improvements in the performance of these companies, but because it will put India on the map. As you know, at least half of investors around the world follow an index. And if India's weighting increases, in other words, if the market capitalization of the Indian market increases as a result of these large state-owned enterprises coming to the market, then investors around the world will be forced to go into India because it's part of the index, the bigger part of the index.
Mark, walk us through your investment process in a market which right now is going to be adjusting as interest rates will tighten. How can one make their portfolio slightly inflation proof?
Well, the best way to have a portfolio that's inflation proof is by investing in equities, companies that have earnings power. In other words, companies that are able to raise prices in line with the increase in money supply and the increase in the prices of goods and services. That is the best way. And of course, that means companies with very high return on capital and companies with low debt. Because with rising interest rates, companies with debt have real problems because their costs go up sometimes pretty dramatically as a result of the rise in interest rates. So that's the best way to protect against this inflationary period.
Mark, closing comments. What is your view on commodities and commodity stocks? Do you think commodities are in a bull run, but commodity stocks are pricing in a lot of optimism?
Well, commodities, of course, have gone up a lot, and they will go up as a result of the increasing money supply and the devaluation of currencies. However, commodities, investing directly in commodities you may make money on the increase in price, but you won't make money by getting some earnings. In other words, if you invest in a company, whether it be a commodity company or any company, you're going to be getting earnings, you're getting dividends, which you won't get by just investing directly in the commodities. So investing in commodities is somewhat speculative. Now, when it comes to commodity companies, you've got problems because as a result of increasing environmental concerns by governments around the world, these companies are under pressure to spend money on pollution controls. And very often they're told not to even mine in certain areas because of the impact on the communities. So I believe it's not a good idea to be investing in these companies. In the short term, you may take some people want to take a speculative bet, but I don't think it's a good idea. You're better off investing in companies that use commodities but have the pricing power.
So if Mark Mobius has to choose between Indian stocks and Indian food, what would you choose always?
Both.
Well, Mark, really appreciate your time. You've been very kind and considerate with your time, and I know you're coming to India very soon, so look forward to meet you very soon.
Thank you very much.
Fantastic. As always, an amazing session with Mr. Mobius. Thank you, Mr. Mobius, and thank you, Nikunj, for that. Ladies and gentlemen, do remember to keep sharing your thoughts, suggestions using the hashtag Voyage2022, and do remember to tag us at the rate ABSLMF. The speaker rating pop-up must have come up. We'd love to hear your ratings on how you thought that session was. On the Twitter part, Joswin Menezes is really doing well and is tweeting quite a lot. So way to go, Joswin. Guys, everybody else out there, ladies and gentlemen, please, we would love to hear more from you on Twitter. There is a prize for the smartest Twitterati of the day. That means the person who shares the most relevant tweets of the day. There's also active Voyager of the day, the person that's asking the maximum number of relevant questions. Yes, I know, unfortunately, because of paucity of time, we can't put all your questions to our experts, but we are taking a look at them back end. So we'd love for you to keep sending in your messages. Also, we have the fantastic contest going on. So do share with the hashtag Voyage2022 why you love Voyage 2022. All right, moving on. Now, our next session, we have Satyabrata Mohanty and Anil Shah, the co-heads of equity, and Atul Pinkar, senior fund manager at Aditya Birla Sun Life AMC Limited. And they'll take us through the process of equity investing and the individual portfolio management styles in the session titled Portfolio Strategies for Consistent Growth. The panel will be moderated by 18 Hours Avan Dubash. Over to you.
Welcome and thank you so much for joining in. Let's kickstart this discussion then by talking about a portfolio strategy for consistent growth. And, Anil, just to take off from that title itself, consistent growth in a very challenging environment such as this. Look at where we are with crude oil prices on the rise. There's a geopolitical tension that's brewing on the brink of war. We're also seeing the overall macroeconomic situation that from the US Fed is seeing a very hawkish stance. despite all of that, the equity markets are managing to hold out quite comfortably. The foreign equity investors as well are now starting to pour back money into the equity markets. And I'd like to begin with you and walk us through what you believe should be the prudent strategy for investors in terms of their portfolio allocation at a very challenging time like this.
Right. Yeah. So, as every fund manager across the world says, equity investing is the best way basically to beat, inflation on a consistent basis. And we now are in a world where, the biggest challenge that the world is facing is inflation. So from that perspective, the first thing that you as investors, you should realize is equity in the medium to longer term is the best hedge against inflation. And, that's the first thing that continue your equity investing. Second, as you rightly said, these are challenging times and you will see, markets being relatively more choppy depending on the news flow that keeps coming through in terms of, rate hikes from the US or on the war front and so on and so forth. So rather than putting large lumps of money at work, it could be a much more prudent strategy to, come the SIP or the STP route and remain invested as far as equities is concerned. Clearly, while interest rates even in India are likely to inch up as we move forward in this particular calendar year, given where inflation is, but we still predominantly will remain in a lower interest rate, regime compared to what India has seen over the last many, many decades. So given that, equity is probably the only asset class which is, available for retail investors directly as well as through the mutual fund route on a seamless manner to invest in, and in a smallest of ticket size that you would want to compared to a real estate and so on, So I think, that's the strategy and that's the thought process that I would leave the investors with.
Which brings me to my question to you, Satyabrata, in terms of, portfolio allocation at a time like this when, one would say, I don't want to really get my fingers burnt in the equity markets. What do you think should be the adequate portfolio allocation to equities, looking at all of the other asset classes as well?
Yeah, see, as Anil said, equities are the best hedge against inflation on a longer term basis, and a medium to long term basis. That is because the earnings tend to grow along with inflation. So that is how the hedge is created against inflation. At least partial hedge is created. So just to go back a little bit, around 2.5 years back, we were telling that now is the time to change your allocation, portfolio allocation, and have a massive tilt towards equities. So if your normal allocation was 60-40 and ratio of 60 equity and 40 debt and others, so that is what the traditional allocation typically people keep in normal times. So we said that it is now the time to go shift towards equity, change the allocation because we were extremely bullish at this point in time. But now, considering there are a lot of things that have cropped up, mainly in the form of inflation and expectation of interest rates hikes happening, commodity price shocks and war. So typically a few of these items, when they go to extremes, typically they create a lot of problems for growth. The GDP growth across the world. So considering that kind of scenario, my advice would be to go back to a natural allocation of around 60-40, moderate it, and then take it forward as things emerge, evolve.
Yeah, and Atul, it seems to be, a consensus call that, allocation to equity clearly is the way to go. But at a time like this, what do you think would be some of the key factors to keep in mind while investing in the equity markets in order to ensure, as the theme of the discussion suggests, consistent growth? Because at a time like this, we are looking at a little bit of a tentative setup.
I think, if you look at investment into equity markets, particularly from, say, retail investor point of view, I think it's important to understand that equity markets, whether it's Indian markets or global markets, the inherent nature of equity markets is they are volatile. Okay, so to tide over the volatility in the equity market, one has to stay invested. Okay, and there are opportunities which the market always provides, whether it is in form of higher rate increases in the US, or whether it is the uncertainty because of Russia-Ukraine war. And these are the opportunities which the market actually provides. I think the best strategy is to stay invested and stay invested for long term. And obviously, one can stagger his investments either through SIP route or through a lump sum, depending on one's comfort level. I think what is more important is investor has to understand his own risk appetite and accordingly, allocate his own money towards equity and fixed income. I think that is very, very important. Second thing is one is to understand that there are risks involved in investing into equity markets, but that doesn't mean that one should stay away from equity markets. I think not taking risk itself is the biggest risk, and therefore investing into equity markets and staying invested for the long term makes sense to tide over the challenging times.
Brings me to my question then, Anil, as to what the outlook is in terms of, the overall individual sectors, financials, for instance. We were just having an interesting discussion with Mahesh Patil, and, they're talking about credit growth returning to this space and, building a long-term portfolio in the financial space is a very prudent strategy. Given the kind of weightage that it has in the markets, is this a theory that you believe one should adopt to?
Yeah, definitely. We not only are we seeing, as Mahesh rightly said, we're seeing credit growth coming back, but it's also the fact that we are seeing capex, capital expenditure coming back, because most of the industries are today working at optimum, utilization, and India hasn't really seen a capex led by private sector for last many years. And I think we're seeing early signs of that. So from that perspective, without a doubt, you will see sustained, loan growth kind of coming back in over the next couple of years. Also remember that as inflation, and commodity prices move up, your requirement for working capital, from company's perspective also moves up, simply because the value of the raw material has gone up. And, that again would mean you need more working capital. So I think, credit growth surely coming back. We've also, the risk and the fear of the NPAs, which had plagued the Indian banking industry going back many years. When you look at it today, we are on a far better and a sound footing, particularly on the corporate side. If you see on the corporate side, it's really, well deleveraged now. And, we don't see any large group or a company out there which, we would be worried from a debt to equity ratio. Coming back on the, the personal side as well, clearly things are on the up end. We've seen particularly on the services sector, there is good employment opportunities there. The pay scales are moving up, and the propensity to consume, is moving up. And, more and more education would mean obviously that people are more prudent from when it comes to borrowings as well. So I think, it really augurs well, if you ask me, to be overweight financials. And, valuation, again, the sector, if you look at, just to add the sector, if you look at over the last 12 to 18 months, has actually underperformed the rest of the markets. And, in that backdrop as well, I would think that, the next 12 to 18 months could be pretty interesting and positive for the financial sector.
Echoing that view regarding the financials, and maybe I'll stretch that point forward to you, Satyabrata, in terms of allocation to the financial sector, given its weightage, do you think that there is that definite tilt towards some of the marquee large cap private names vis-a-vis the PSU, or would it be sort of an equal allocation?
Yeah, obviously the weightage of the large cap private sector banks are significantly more than the PSU bank pack. So definitely the tilt will always be towards the private sector. But the way we approach investing here in Birla Mutual Fund is actually we don't try to classify stocks into private sector, public sector, and those kind of buckets. What we follow is the growth at reasonable value approach, and maybe with a slight tilt towards more towards growth. But so what we do, it's apart from we basically focus on the fundamentals of the company. We do a bottom-up approach, and if it makes sense for us to invest in any company, so whether it's private and public, it comes later on. If there is enough margin of safety, enough growth opportunities, and the management is executing it well, so we'll go ahead and invest. So we don't approach it from a private sector, public sector, or that kind of view.
Fair enough. Atul, I just wanted to talk about the entire CapEx theme, because there seems to be a lot of faith in the way the government has focused on the infrastructure sector. There have been a lot of policies doled out on this front, a lot of reforms and initiative that has been taken by the government. In terms of where India stands versus some of the other emerging markets, do you think that enough has been done on the policy front and that we do have a leg up in terms of the macroeconomic situation versus the other emerging markets?
I think one can never say enough has been done. There's always much more that can be done, and that's true for every country around the world. But I think we really stand out today when we compare ourselves with any other emerging economies. Okay, from the perspective of the fact that we are not. When you look at the country as a whole, okay, we have various sectors across in which we have proven track record, and the world is looking for an alternate sourcing base compared to just being relying on one large country. And India again features in many of the many sectors for a sourcing base from that perspective as well. We are a large market by ourselves for our products. So given this perspective, I think from a reforms perspective, we've seen the PLI schemes coming through. We've seen a lot of focus on power sector reforms coming through, and I think all these things are really showing up. When we look at the economic growth that we are seeing on a month-on-month basis, as we see right now. So I think we're on the right track. Okay, absolutely. And if for good reasons, if inflation across the world can be curtailed and very quickly, then things can even get more rapid and better from India perspective. So right now, the only worry that really India has, okay, is primarily oil. We are large importers of oil, and oil being basically the lifeline in terms of transportation, that cost seeps through across every product line, and that's the only worries. I'm just from a perspective of reforms, but other than that, as I said, things seem to be absolutely going fine.
Atul, would you echo that sentiment when it comes to the macroeconomic backdrop and how India stands versus other emerging markets?
Yeah, so if you look at historically, India has underinvested in creating large infrastructure. I mean, there is absolutely no comparison which one can draw between what has happened in India versus what has happened in China. And then there is a lot of catch up to do in terms of investing into infrastructure. And rightly so, when you look at the budgetary allocation which the government has done year after year, there is a clear preference towards allocation to CapEx and infrastructure as compared to revenue expenditure. Obviously, there are constraints from the funding side, but I think there's a lot of realization that investment has to go into creating infrastructure, whether it is road or whether it's ports or highways or railways. I think that is something that we are seeing in the budget and government allocation in terms of investments. Obviously, there are different parties who are getting involved in here, where the government is in one side, and the second leg is in terms of private capex, which has been lagging till now. But I think with the way Indian economy is growing, we believe that it's high time that the private capex will materialize in the next 1 or 2 years. I think PLI scheme is one scheme where we have already seen significant amount of interest from private players, and I think that private capex will soon follow through.
Satyabrata, would like to get in your outlook as to how you're looking at some of these investment related themes or these capex related themes, would sectors like infrastructure, real estate, capital goods, would all of that then be on the radar?
Yeah, as Atul said, we in India have underinvested in infrastructure, so we need a lot of investments there. So we think as far as the communication infrastructure goes, and the transport infrastructure in the form of roads, railways, ports, airports, etc. So we are seeing a lot of thrust being put on building highways, connecting different areas, developing new ports, developing airports. We have seen a lot of airports being connected, and a lot of parts across India have been connected. So in that sense, we are quite positive on the infrastructure spend that we are going forward. That's why there are certain subsectors within infra that we are quite positive. Apart from the infrastructure sector as such, we are also positive on cement sector because it's quite linked to infrastructure, and also as we think the real estate sector is also has also turned around. We expect it to do well going forward, and the demand from that sector towards cement also should be quite strong. So in that sense, we are quite positive about that particular space.
What about, the entire consumption theme, Atul, in light of the fact that companies have acknowledged that the raw material price inflation is real, especially at a very turbulent time like this with what we're seeing with Ukraine and Russia play out? Is there a worry that these fears of high inflation are likely to play out for the long term when it comes to looking at the entire consumption basket?
Beyond a doubt, when you look at the way raw material prices have gone up across, various commodities, whether it is a consumer staple company or whether it's a consumer durables or consumer discretionary car OEMs. And so, across the board, we have seen that raw material prices have gone up. And in the very near term, it's definitely going to impact the margins. Companies on their own are kind of taking price increases in a very calibrated manner, because a very sharp increase will actually have a negative impact on the demand. So I think companies are gradually taking price increases across product categories. So very near term, we believe that as long as the raw material prices are higher, it will impact margins in the near term. But as this price increase comes through, we will see that margins inch up going forward. I think more important is from medium to long term, one really has to keep an eye on the demand front, because as long as the demand is good and with the scales and the price increases been taken by companies across the board, we believe that margins should come back. And with scale and the phenomena which we have witnessed over the last 3-4 years, where the organized sector has taken away market share from unorganized sector, we have seen that companies are in a much better position to take price increases, because the competitive pressures from the unorganized sector is kind of dwindled down. And therefore, from medium to long term perspective, not too worried on how margins or earnings will get impacted because of the raw material prices going up. It's a very near term phenomena that until the price increases catches up with the raw material inflation, we will see margin pressure in these companies.
So to add to what Atul was telling, what we do is that our view is that margins, especially which fluctuate depending on the increase in raw material costs, etc. So we tend to think it's much more cyclical. So our approach is to focus on companies which are leaders in their categories, have strong brands, and we think during these times, these companies tend to increase their market share, and we believe that as the cycle changes, then things normalize, and these companies tend to benefit a lot. So we generally, our approach is to think that this is a cyclical thing. So better focus on the quality of brands and the management of these companies.
Where there's also strong earnings visibility, risk reward looks favorable as well. So Anil, when it comes to just taking forward this strategy, is the sense that you're getting that when it comes to the upcoming quarter, maybe we will see pressure on earnings, but if you were to take a long-term view, look at it from a 3 to 4 year time frame, the earnings picture in India looks resilient, looks strong, and that companies will be able to tide over some of these concerns, inflationary concerns in particular.
Yeah, I mean, not necessarily all of them, but, yes, I think, some of the companies that, as Satya mentioned, we need to pick and choose, do our due diligence, dig deep, go back to past history in terms of, whenever there was an inflationary trend going back in earlier years and earlier decades, which of the companies were able to withstand this, and look at competitive pressures across the sectors and, within that. So, yes, I think, there have been enough companies in India who have managed to tide over, short-term crisis or short-term, inflationary pressures. But, as we've always kept saying, equity investing is, from a longer-term perspective, and that's how wealth gets really created. Yeah. So, yeah, no two doubts that, inflation will be a shorter-term phenomena, and we will probably see, better times from an earnings and a margin perspective.
Atul, what's the advice then for, say, some of these new age investors who are looking at the markets? They're fresh into, exposure into the equity markets. There have been some of these new age tech companies, etc., that they're looking at. But just from an SIP point of view, what would be the appropriate advice?
I think, as I said, one really has to understand his own risk appetite and accordingly invest into market, because there is clear risk when we are talking about investing into equity markets, and therefore one should not really get carried away by the way the markets move, whether it is on the upsides or on the downside. So one has to have a disciplined approach, pick the right themes where one wants to invest, and the approach should be long-term in nature. So what are the underlying companies who are kind of has a durable business model, scalable business model, they have quality management, or they have some kind of moat in the business, which gives them the advantage of gaining market share year after year. And these are the companies which kind of gives you that earnings growth on consistent basis. So having those companies in your portfolio does help to kind of deliver consistent growth over the medium to long term perspective. And most important is in this kind of market environment, one has to be cognizant about at what valuations one is looking to buy or invest into these companies. I think that is something that investor also has to take into consideration while investing in this kind of companies.
Yeah, I'm just going to also have a glance at some of the viewer queries as well, that the participants as well that have joined in. And Josephine has a question. I'm just going to pose the question. I leave it to any of you to answer. Asking how the current rate hikes and the slowdown with the war-like situation is likely to affect equity markets in the short run. He asks, will it provide more opportunity with further corrections in the markets? I leave it open to any of you.
Yeah, so maybe I can take that question. I think these are all relevant concerns in the market at this point of time. And therefore, market will react to depending on how the events unfold, right? So from that perspective, market will provide those opportunities as and when the concerns plays on investors' psychology, and we see drawdown in market. I think and therefore, one really has to think very long term while investing into equity as an asset class. And pick the right asset allocation depending on the risk appetite.
As far as the interest rate hike part goes, see, war is something that is uncertain when it is supposed to end. We don't know. We are not really expecting this to continue as long as it has continued the Russian and Ukraine thing. So it's unpredictable to say when it's going to end and when things are going to normalize. But as far as inflation, as far as interest rate hikes by US Fed goes, so now you see, that is the tricky and the risky part as far as equity markets and GDP growth is concerned. Because we have seen in multiple times previously that aggressive interest rate hikes have exceeded what was required and resulting, and they create going forward a recession in the US and global economy. So that's the risk that we should be aware of and always should keep an eye on it, that the central bankers don't do an excessive interest rate hike than what is required, which those concerns are also getting reflected in, if you see the inverted yield curve in US. So that is something that we should be a little bit worried about and keep an eye on. So the best case scenario will be that the interest rates hike will be moderate and enough to take care of inflation, tame inflation, and not just go and create a recession because of sharp interest rate hikes.
Anil, I wanted to understand your view as well as to how investors should be approaching the entire digital theme, because that's one that's been garnering a lot of attention. You know, digitization, new age tech companies have certainly been hogging the limelight, but you also tend to get your fingers burnt with some of these new age listed companies, for instance. As we're looking at the overall digital world, I mean, I was just saying, look at where we are even today with all of us remotely taking a conference. So give us a sense as to how you're looking at the environment currently and how conducive it is. Is new age tech here to stay? Is that a sector that you would look at closely?
So look, as you rightly said, as the word itself suggests, new age tech, it's constantly evolving, and without a doubt, they are here to stay some of them and grow rapidly. They are also disruptive for some of the businesses on whom they basically unleash their new technology, be it a process or be it a delivery mechanism. Because these models are not completely clear right at the outset.
Anil, I'm afraid there's a little bit of a disturbance in your audio. We felt it in the previous question, but maybe we'll try and sort that out. Would you, Satyabrata or Atul, like to take forward that question, the outlook on the digitization, new age companies and this theme?
I think digitization is here to stay, and we have seen that happening in the US, where the new age companies kind of challenge the well-established businesses, over the last, who had kind of has a very steady business model for the last, say, 30, 40 or 50 years. And, their business got disrupted. It's across industries that we have seen, whether it is, auto space or retailing, or for that matter, in the financial services sector. So I think that's here to stay, and and therefore, from the incumbents' point of view, they really have to adapt to the changing environment, and which is where the entire digitization or investment into the change the business space is happening, which is kind of benefiting the Indian IT services companies. Because most of these Indian IT services have kind of, over the last many years, transformed their business model and, are now very relevant in the market space. And therefore, they are able to capitalize on the opportunity which is being posed in the market space. So I think that is what is happening globally, that, the new age companies are challenging, are disrupting the established companies, the incumbents. And the incumbents are reacting by investing into technology. And India is no option. Nothing different, right? We have seen the similar trend happening in Indian markets as well. And I think that's the way, and that's the new reality in the market. So you have to adapt to change, you have to agile, you have to disrupt your own business model to be able to survive and grow in the future.
Okay, let's try and take on board some queries as well coming in from our viewers. And Anup has a question for you, Atul. He's saying, I want to know more about the tax relief fund and how it could pick up from here. Would you like to share any insights?
So, if you look at the way the portfolio composition is or has been for tax relief 96, the focus had been historically on investing into very high quality companies, and because of that, what we see is the portfolio kind of when you invest into high quality companies, whether it is in the healthcare space or consumer discretionary space, or for that matter, the financials, or so these companies kind of go through a phase, and therefore, particularly the last 12 to 18 months, where growth predominantly outperformed value or quality, that really has impact on the quality stocks. But when you look at from medium to long term perspective, quality always comes back, because what we mean by quality is companies have over the last many years have a proven business model. They have scalable business model run by good quality management, and importantly is they have a very strong moat. The way forward, what we are looking at is we are aligning the portfolio in line with the new market reality, and the new market reality is that when you look at from next 3 to 5 years or maybe 4 to 5 year perspective, as we transition from a $3.5 trillion economy to about anywhere between $5 to $6 trillion economy, the way per capita GDP per capita is going to almost double over this period. The consumption, there is a shift in the consumption pattern, and accordingly we are realigning with that market reality by investing into those companies with clearly a 4 to 5 year time horizon. And that's how we are transitioning the portfolio. But having said that, this transition that we are looking at is in a more gradual manner, because we don't want to really disrupt the existing portfolio and slowly kind of build the portfolio towards the direction.
Vimal has a question, and I don't know if either of you will be brave enough to answer it, but he says, where do you see the Sensex 5 years from now? Would you venture a guess, either of you, Satyaprata or Atul?
You can venture a direction. See, longer term, the direction is easy to guess. So I am quite sure that it will be higher than what it is today. But actual level will depend on that particular time period, what the macroeconomic factors are, and what are the factors that affect valuation and liquidity, etc. So, but 5 years, if you ask me, definitely. So though I am a little bit concerned about near term because of war and inflation and interest rate hikes, if you ask me whether over a period of 5 years, am I positive about the equity markets, and do I think it will give returns which will beat inflation going forward in the next 5 years? I definitely believe it will. So that's our
okay. Okay, so that's the view, taking perhaps a safer route, saying that you're positive long term, but not venturing with levels. And of course, I'm not going to probe. But Atul, just wanted to understand from you what the long term outlook is when you're looking at the entire energy space as well, in light of the fact that we have seen, crude oil prices that have been on the boil, and it remains, so volatile because it's attached to all of the new headlines that we get day after day. So what's the sense that you're getting when it comes to outlook on the energy sector?
See, energy sector, one really has to look at a more cyclical play, okay? And, that's how the sector and the companies within that sector actually perform. So there, and particularly to energy sector, one really has to look at which are the companies which can make or transform their business model. And there are a few of them which actually are moving the ESG part and investing into green energy and creating the infrastructure for EV charging. I think these are the companies who have right to win in that sector. And these are the companies which will perform well and will be counter-cyclical as compared to the historical perception or the way companies have behaved in a more cyclical manner in this sector.
So the problem in the energy sector, the way I see it, is that there is a huge underinvestment in new capacities. It's mainly because of this the ESG thing that's going on. So because of the ESG investment, so a lot of these traditional energy companies are not invested in increasing their capacity. So that is also fueling part of the rise in energy prices is also getting fueled by that. So somewhere we have to find a balance of how to take care till the transition happens. But transition is not going to happen so quickly in a short period of time that we move from fossil fuels to green overnight. So it will take time. But during that time, when it takes, there could be a massive mismatch in demand and supply. And that could create its own uncertainty and own inflation and its own shocks to the economy. So we have to see how it plays out.
Just final thoughts then, and Atul, wanted to get your outlook in terms of, since it's, and the outlook of the investment philosophy and style. Is there any sort of a construct or some sort of a to-do list that you would keep in mind while, going for sectors, going for companies? Of course, you did speak of strong earnings visibility, large cap companies that have proved their worth, etc. But just in terms of building up long-term wealth and long-term wealth creation, how would you advise what should be the checklist rather that investors should look at if the retail investors are looking at the long term?
I think the investment philosophy is, a growth at a reasonable price. Talked about it earlier, because India essentially is a growth market and also an emerging market, and therefore, what we believe is GARP as an investment philosophy is really suitable for a market like India, because investing into growth companies does give you that opportunity to participate in the longer term growth of those companies, and buying those businesses at a reasonable valuations helps you to kind of reduce the underlying volatility in the Indian market. So I think that's a very apt investment philosophy to have. But I think more than that, one really has to look at, and the way I construct my portfolio is basis a combination of top-down and a bottom-up approach. And what I mean by top-down is basically looking at basis of macro analysis, which are the sectors from medium to long term, where the view is positive, and which are the sectors where I want to be overweight or underweight, and then deciding on the underlying companies within those sectors which could outperform the sector. So that's the bottom up stock picking, and therefore when one looks at the attribution analysis, you'll see that a significant portion of the attribution is basically because of stock selection. So I think underlying stocks or businesses that you invest into delivers the majority of selection effect in the portfolio. I think from long term, I think that is something that a allocation and bottom up stock picking helps the portfolio to deliver consistently higher risk adjusted returns. And that is something that one really looks at when investing in liquid markets. And there are two clear focus areas. One is how do you create alpha in the portfolio on consistent basis, and at the same time is how do you manage risk in the portfolio, because one cannot really take undue risk in the portfolio to be able to generate alpha, and therefore these two parameters goes hand in hand.
And would you like to walk us through your portfolio strategy, Satyabrata, the investment philosophy?
Yeah, the investment philosophy is the same as what Atul said. It's growth at a reasonable price, maybe slightly more tilted towards growth than other portfolios. So, so that being the basic philosophy, so what I tend to do is that we're trying to identify company sectors from a top-down basis, which have a long long-term outlook, positive outlook. So then we tend to identify companies within those sectors on a bottom-up approach basis. So typically what we do is we end up with creating a portfolio of companies which tend to have higher growth rates than the broader indices with strong operating margins and strong cash flows. So we give a lot of importance to not only to the earnings per share, but also we give strong importance to the cash flow generation that the companies are doing. So typically we stay invested in sectors which have long-term positive outlook, and typically the companies within those sectors will be the top companies which have strong dominant market share with strong margins and strong cash flows.
Anil, you're back with us. So what's your outlook then in the long term on the equity markets? We had a viewer asking what the Sensex would look like in the next 5 years. Dare to hazard a guess?
No, so in the next 5 years, I think could well define, India, to be very honest to you. Okay. I think this is probably the biggest opportunity post-independence that, India has got in front of it. We have a vibrant, domestic market of our very own, thanks to the 1.3 billion population. We now have the world wanting an alternate, as I said earlier, from a sourcing-based perspective. I think COVID taught the world you can't over-rely on any one country for your large production or large base of requirement. And I think, India in many, many sectors will find itself being pretty reasonably well suited out there. So, I'm looking very, very excitingly that, we would be in a position wherein you're having, aspiring middle class growing by the day in India. Their wants and their requirements will be there. You're seeing, relatively lower regime of interest rates in India, which has begun over the last 12, 15 months. And you're seeing a much more, opportunities from a global perspective. So I think the next 3 to 5 years could be so exciting in India that, equity markets could run ahead of its time and, generate returns which could be very, very exciting, 25, 30% in some years. But over the next 5 years, possibly, we should be easily doubled and more.
Easily doubled and more. On that positive note, then I'll wrap up the discussion. Thank you so much, gentlemen, for joining in and sharing with us your insights and your investment philosophy for consistent growth.
Thank you.
Thank you.
Well, thank you so much for that, Awan, and thank you to Satyavrata Mohanty, Anil Shah, and Atul Penkar for sharing their thoughts on this session. Ladies and gentlemen, as always, the speaker ratings have come up. You can please do share your ratings on how you thought the session was. Also, before the next session, quickly, we have another poll coming up for you. A very interesting poll. This is, in fact, for our distributor friends who have logged in and are watching. And I think it serves perfectly well as a segue into our next session, which is with mutual fund distributors. So here's the poll. Here's the question. With most of your clients, what is their preferred method of interaction with you? Is it through WhatsApp or SMS? Is it through a phone call? Is it through email? Or is it in-person meeting? We'd love for you to choose one of these options and let us know your thoughts. Is it WhatsApp, SMS? Is it phone call? Is it email? or is it an in-person meeting, which is the preferred method of interaction that you feel is the one with your client? Now, while you put in your answers, I will share those the statistics with you after this next panel. But this is a very interesting panel that is coming up. It's our last panel for today, but it's going to be a fire-powered one, I believe. It's going to be very interesting and fun as well. So we've got different experts from the distributor network who've come together, and they're going to talk to us, share their insight, their thoughts, what they think are some of the trends for the way ahead, why they think time in the market is more important than timing the market. The panel will be moderated by ET Now's managing editor Nikunj Dalmia, and he'll be in conversation with Lovai Navlakhi, the founder and CEO of International Money Matters, Rajesh Bansal, co-founder and MD Midas FinServe Private Limited, Brijesh Dalmia, founder at Dalmia Wealth Private Limited, and Mohit Gang, founder Moneyfront. So they'll be on in just a minute.
Well, good evening, everyone. It's such a pleasure to be associated with Voyage. Every year, we look forward to just engaging with the members of Birla Mutual Fund family, fellow investors, and just to get a sense of how exciting things have been in the investment world. Normally, I would start the first session in Voyage, but this time, perhaps the organization has told me to do the last session of Voyage. So things are indeed changing, as you can see. And I've got somebody from the Dalmia family also on the panel today. मेरी मुलाकात इनसे कल ही हुई ब्रिजेश जी से. Trust me, we don't have any family tree collection, even though his firm's name is Dalmia Wealth. Brijesh ji, I'm looking for that wealth. बिरला म्यूचुअल फंड में ढूंढना पड़ेगा लगता है. देखिए, जब वेल्थ शेयरिंग की बात आती है, डालमिया जी म्यूट पे चले जाते हैं. अब म्यूट पे साहब.
I'm saying that you have enough of it, and I think I can help you enhance it.
We'll talk about it. We'll talk about what is the best way to create wealth, generate wealth, and not to destroy wealth in this kind of a mutual fund market. But just tell us about your journey. Tell us about what kind of clientele you are associated with. Tell us a bit more about Dalmia Wealth, and tell me rather, how can you help me generate wealth? The last part was very important.
All right. So, Nikunj, we have been into this for last 20 years. And God has been really kind. The industry has been really kind that, things have moved in the right direction. Maybe we were lucky we were there at the right time, at the right place. And we started our journey with mutual funds, and our clients started with small investment. And thanks to all the AMCs and the markets that they have done so well, and mutual funds have been able to preserve the wealth as well as enhance it. And so our job was made much easier, and the journey has been fantabulous. Clients have made very good returns. We have been, happy along with the journey. There have been ups and downs, 2008, 2013, 2020, but all of that has been taken into stride because the returns that have been generated and the confidence of the client in mutual funds every single year is going up, and the panic is going down. And mutual funds as a product has been established in the marketplace. Of course, we have a long way of adding more number of folios and KYCs, but I think the journey has been fantastic, and I think we can. It is just the tip of the iceberg as we stand today, with much more growth to come. And as far as the Dalmia Wealth is concerned, we are a kind of a boutique mutual fund distribution house where we have around 150 families. Most of them started as retail, but now they have grown as some superpower at the national level, and they have decided to stay with us. And probably they are happy. And what we do is that I think when I look back and say that what did we do for our clients? So I will say that rather than giving them fantastic returns, we have been able to preserve their wealth. We have been able to make sure they do not make many mistakes, and because they did not make mistakes, they have been able to create wealth, and that is our contribution to the entire journey with our clients.
Wonderful. So you've helped people preserve wealth, but if I want to create wealth, how will you come? How will you help?
Now, my job starts after you have probably on the journey of creating wealth, because so I'm not into backward integration. Maybe I'm into forward integration.
Rajesh, tell us about your firm. How many years you've been in this business? What kind of clientele you are currently servicing and associated with?
Nikunj, though I had been to this financial service industry for last 29 years, but I founded this Midas Finserv 7 years back. Before starting of this Midas Finserv Private Limited, I had been associated with various reputed organizations like Tata Mutual Fund, ING Financial Services, Master Capital, at various reputed senior positions. Midas Finserv Private Limited is a boutique wealth management company, and which is serving more than 1,500 families and helping their financial goals. We are using both kind of the product, like asset-based and liability-based product. So on the asset side, we use like mutual fund, PMS, AIF, life insurance product as well, ULIP, fixed income, term plan. On health general insurance side, like health insurance. On the loans liability side, we take the loan portfolio of the client to meet their short-term or long-term loan requirement, like home loan, loan against property, business loan. And as far as my journey is concerned, I am very satisfied. Spent over the time spent in this industry, as Mr. Dalmia said, thanks to the market, thanks to the various MCs, thanks to the fund managers who help the clients not only to preserve wealth, but also to create wealth. Of course, I am a very lover of equity. I am a technical analyst by profession also. And we have a strong research team, which is our USP as well. We help the client to create wealth in this environment, and with our strong acumen to the equity market knowledge and the research, we help the client at various intervals. Though we stick to the basic principle of investment, but at times we also make use to preserve the wealth at different intervals, like 2018, 2020, or also go aggressive on the equities when the market provides that kind of the opportunity.
So investing in a mutual fund is thinking years and decades. Technical analysis is thinking minutes and hours. The quarter is a dial of a quarter, and for SIP investor, a quarter is like at least 25 years. So how do you manage both?
Sir, of course, you said we follow the basic principle of investment only. Then defining the goals of the client, sticking to their financial asset allocation, sticking to the financial goal, and using the technical analysis only at times to make the tactical allocation or to tweak certain times. Like, for example, in October 2020, when the market has a sharp run up, and like when the Nifty was trading around 18,500 or so, still there you get the client, their money has to be invested. And a lot of people are looking for the lump sum investment. And in when the markets are high, everybody wants to make quick bucks in the market. At that time, to control the behavior of the investor is very important. At that time, our model was suggesting it's not time to go aggressively on the equities, be slow. So we use this STP method at that time rather than to go aggressive on the equities. And similarly, like in March first week, when the Ukraine war is on, markets have taken a sharp dip. Then we were very aggressive on the equity, and we went out with strong communication with the clients to go aggressive on the equities and make the lump sum investment. That's the only use of the technical knowledge. Otherwise, it has to be the basic principle of investment.
Wonderful. Mr. Navlaki, tell us a bit about your firm, your experience, and again, the client profile which you're servicing.
Yeah, hi Nikunj. So I started Money Matters, as it was called then, in 2001. Came out of pink slipped in the job market, so pretty much forced to start off. Didn't do it by choice, but I had a first few set of colleagues who had invested with me, and then realized that this is a lovely business to be in. A couple of things that have helped us through the years have been that, one, act in the client's interests always, and two, try and educate them so that they become aware about things. We don't use jargon, we try and simplify things. And I think over the years, we have been fortunate that we've been allowed by our clients to learn from our mistakes. 2008 crisis, at that time, we realized the importance of risk profiling, because many clients we sort of followed their sort of push to increase equity in 2007. And when things turned bad in 2008, they said, "Oh, you know us from so long. How come you allowed us to increase equity?" And thereafter, we decided that we will, follow risk profiling and asset allocation very, very seriously. As a result, I think as a firm, we have not exceeded maybe 60 to 65% in equity at any point in time. We might have gone to 50% in equity overall. While we deal with all types of clients, we realize that we can make much greater impact on people who are sort of have the ability to invest in excess of 3 crores of money, at least head there, because then we can give them the variety of products that we are capable of giving. In 2005, along with the time when I completed my CFP, I think Brijesh and I finished CFP together 2005, where we didn't know the F of financial planning. And I think we've learned along the way. And around that time, we converted my firm from a proprietorship to a private limited company. I just started visiting the US on conferences. So thought international will be a good flavor to add to the name. And in a way, I've been forced to make sure that, keep up in pace with whatever developments happen internationally. So very early, I would think, in trying to tell clients that they need to have international allocation when you look at asset allocation. Of course, the range of products that were available maybe 10, 12 years ago were very limited. Only feeder mutual funds it started off with. But now you have the whole range, including platforms, investing through liberalized remittance scheme, etc. So happy to be in that space. And we again been fortunate by the set of clients early on who told us that, you're doing something extra, why don't you charge fees? So we were fortunate to start charging fees to clients in 2003. And then over time, we have continued doing that. So when RIA regulation came, we did license ourselves as RIA. When they allowed RIAs to get clients to invest in direct funds, we have moved clients into direct funds. So most of the investments that we manage in mutual funds is direct. And we charge fees. And yes, it is difficult in years when markets don't do well to get the fee, but we have to tell them that and remind them of the good years and say we didn't take a big fat piece of your pie at that time. So yeah, it works that way. Now have been in business for 20 plus years. And are present in 5 locations. We have a 50-member team. So there is that task of even managing team apart from managing client.
Well, you've created a franchise. Congratulations. With the same question, we would love to understand how many years of experience you've had, what kind of services and what kind of clientele do you deal with. Mohit?
Hi, Nikunj. Good evening, everyone. And look, so I, Nikunj, typically track my lifespan in this industry alongside the industry itself. So I started in 2005 when the AUM of the industry was 2 lakh crores. And that time I started my journey with Citibank. I was there for 10 odd years. Then I moved on to HSBC, and 2016 is when I cut off from corporate life. And we started our own journey and charted a platform called Moneyfront. So that time the market was around 16, or the AUM of the industry was around 16 lakh odd crores. So in proportion to the industry, I've been making my moves basically. But in 2016, when we started, Nikunj, we were the first digital RIA platform in the country at that point in time to offer completely digital paperless solutions to clients under an RIA license, basically offering direct plans as Lavai also kind of mentioned, basically. And since then, our journey has seen many ups and downs, many twists and turns. Along with regulations, we have also tried and evolved our practices, our efforts to service our clients. As I'm talking to you, we have been lucky that we service around 20,000 plus clients across some 985 cities in the country, in this country today, and across some 16 cities globally, basically because of our digital reach. We also have a unique unit of boutique advisory, where we service some large family offices and corporate clients on the treasury front, basically. So we have a mass and a mass affluent segment which transacts or which interacts with us completely digitally because of our platform and services. And we have a set of clientele which is more boutique in nature, where we offer complete range of our advisory services, basically. So that's been our model. And happy doing this journey of investments and learning along the course and interacting with clients. That's been my passion all through.
Mohit, the new India which we are talking about is the millennial India. People are shifting their asset allocation, SIPs have started. So today the market, what we are staring at is perhaps not because of the old timers who are putting more money, it's the new Indians who are not going towards fixed deposits. When you talk to your clients, are you also getting a sense that this is a long-term, multi-year trend?
Oh, totally, Nikunj, totally. The kind of changes in the dynamics which I'm seeing on the ground, the pulse of it is very, very different than what I saw like 15, 16 years back when I started this journey, right? So today, everyone is in a fast track mode. Everyone wants to retire early, and that's something. So my pet pitch to our clients is, look, you working from 9 to 6, basically, that's your active income. But what about your passive income? Unless you build a kitty of passive income, which works from 6 in the evening till another day, 9 in the morning, right? Then you're really not building something out for yourself. And that pitch particularly has worked very well with our set of investors, basically, who wants to create a passive set of income, who are in that fast track mode to retire early, who want to interact with us more digitally, basically, and who want to explore different types of assets and different types of offerings, basically. So yeah, you're right. I think the demographics, the patterns, the behaviors, the psychology behind investing has changed dramatically, and the trend of investing in FDs and gold and everything has gone through phenomenal change and shifts, I would say, right? Incrementally I come along clients who are in that age bracket of 50 plus kind of age brackets, and who no longer want to invest in fixed deposits or NCDs. They're looking for different avenues. They're looking for mutual funds because they've heard so much about it, right? We have to actually hold them back at times and tell them that you have to create a proper asset allocation and move alongside both debt and equity and preserve your capital also. So at times it gets tough because everyone seems to be in a rush, and that's more because of the market trend and the movements recently. But yeah, you're right there. The behavior and the psychology behind money has changed completely.
But Rajesh, we are feeling very happy. I remember when we were doing the first edition of Voyage, the most important trend was that we would track the FI flows. More than earnings, we would track the flows. Today, FIs have been selling in Indian markets are not even sneezing. There was a time when FIs would sneeze and we would catch a flu. And that's largely because of domestic investors. Now you have the pulse of the market. Aapko kya lagta hai, Rajesh ji? This entire SIP flow, money into balance fund, money coming from FD to equities, that's a multi-year trend?
Of course, Nikunj, as Mohit has rightly said, there is a complete change in the human behavior, in the investment pattern of the client. मैं आपको छोटा सा एग्जांपल बताता हूँ. 25 years back, जब मैंने इन्वेस्टमेंट जर्नी स्टार्ट की थी, तो मेरे को याद है हमारे घर में, हमारे रिलेटिव के घर में एक लड़की, गर्ल वाज बॉर्न बस, एंड दे सेड कि दादी जी ने कहा था कि इनकी ना एक LIC की पॉलिसी ले दो, कुछ FD कर दो, बिटिया की शादी के लिए पैसे काम आएंगे. तो देयर वाज अ टाइम एट दैट people used to follow the traditional way of investment, and those were only fixed deposit, or the buying LIC policy, or people have some more money buying the property or plot and etc. But nowadays I feel differently, total different behavior. People come and ask for the mutual fund, they understand the equities. People, even the new generation, right now I am being approached by a lot of young guys who have just recently started their jobs and they started their career. Even they're looking for the direct equity. Even they just all want to make quick bucks in the markets, and they're not afraid. Even I'm sometimes, Nikunj, I'm just get perplexed. Young investor buying call and put and asking me certain times of the guidance about the call put options. Even they all are in hurry to make quick money, where we have to teach them the basic principle of investment and they have to stick to their asset allocation plans. So a lot of things have changed, and definitely this is the change in the human behavior which has helped the Indian market to recover from the sharp, strong sell-off from the FIAs. I had seen the markets making bottoms at different periods in last 2 decades when the FI were the net seller, but at that time FII were forced to turn buyers at the higher level, because for last full months of February or in the early March, we have seen the FI were consistently seller. In fact, since October, they are the consistent seller, and they are now turned the buyer. And in the last leg of the rally, they have turned buyer. And it is just because of the change active retail participation. And this we were anticipating for last couple of years, because now we see a lot of retail investors saying no interest in parking their money, making fixed deposit at 5-6%. They don't find any value. Now they have understood the role of the inflation, and they don't want to not only preserve wealth, they want to create wealth.
Rajesh, why do you think ऐसा हो रहा है? Why do you think that there is a shift in approach? There is a shift in portfolio planning. ये गंगा अचानक उल्टी क्यों बहने लगी है, ब्रजेश? वो मीडिया को थैंक यू बोल रहे थे, मीडिया ने स्प्रेड करी है, म्यूट कर दिया. दोबारा बोल सकते हैं?
Okay, so in my opinion, I think the emergence of nuclear family is one of the biggest reason why people have started thinking that savings and investments are very important, because now they have to take care of themselves. The other thing is that they have witnessed the growth of the equity markets and the investment market in the country. They have seen that their friends, colleagues, relatives are making tons of money in their investment portfolio, and so it's catching fire. People have experienced investing over the years, and thanks to AMCs as well as the distribution fraternity, they have been able to reach out in scale in crores of families to tell them the power of investing. So I think it is irreversible. Now people have understood the concept of investing, and the job, I remember 20 years ago, I have to tell them what is mutual fund. Then I have to tell them after 2-3 years what is SIP. And then, now, and then I have to tell them what is debt fund, why you should invest in a debt fund. Now the situation is this, that if bank FD is giving 5% and the client is getting 4% in a debt fund, still they come to say that let us go for the debt fund. It is convenient. It is easy. I don't have to do anything. There's a gradual shift that the thought process of the investing public is changing because of the maturity level. And I think as Rajesh ji said, and as Lovai said, I mean, there's a huge difference in the sentiment of people. For example, this Russia-Ukraine war, we did not get a single call from a single client in terms of what is happening. They are so okay with it, क्योंकि market नीचे जाएगा, market ऊपर जाएगा, SIP बढ़ा देते हैं और पैसा डाल देते हैं. 10 years ago हमारे पास ये कॉल नहीं आता था, बाजार गिर गया तो पैसा डाल देते. अभी क्लाइंट सामने से फोन करके बोलता है कि बाजार गिर गया, is it the right time to invest or not? So I think this nuclear family concept, the emergence of market, 50-60,000 index, people, there's a feeling of losing out, if I'm not there in the market, if I'm not investing, I will miss out on something. So all these factors are contributed to all these things.
Sumit, I can see you on the preview. I'm trying to understand the expression on your face, Sumit.
I'm impressed. This is great. This is great things that I'm hearing.
Rajesh, so while it is good that markets have fallen, people are not cancelling their SIPs, whether it is the approach, attitude, education, awareness, returns, which have genuinely made people wealthy and happy. My question, Rajesh Bhai, is, last 2 years have been more like a Goldilocks scenario. Whatever you've bought, you've made money. Now is the testing time. Debt के अंदर return compromise होगा, equity markets may not give you the kind of stellar returns what we've seen. So what are you telling your clients now? 3 years, 5 years, and 10 years? Rajesh?
So this is a very interesting question, and I will tell you exactly how I think and what I think. Over the last 10 years, not in the first 10 years. So this is my 20th year in the markets, let's say. So the first 10 years, I thought I am smart. I know how to make money. And the last 10 years, I have become wise that I don't know how to make money. I know how not to lose money. And that has helped me create more wealth for myself as well as my clients. So making less mistake. And why I say this is that last year also, January, I thought equity markets will not give a very good return in the next financial year. Last year, I thought debt market will not be very good. For the first, equity market gave phenomenal returns last year also. And if we take out the Russia-Ukraine war, it was even better. And debt market for the first 9 months gave fantastic returns. Only in the last 3 months, they were not very good. So I went completely wrong last year. This year, again, I think that, the markets are very high and debt market is bad and returns will not be there. But this market has the tendency to surprise everyone. And now I behave in line with the market that I will accommodate, adjust my strategies along with my client. Whatever market is there, I will behave like that. But to answer your question, I fundamentally believe that Indian markets are trading expensive. They have been trading expensive. The media always tells us that, Indian market gets a premium because of blah, blah, blah factor. But I have this fear that at some point of time, maybe 1 year, 3 year, 5 year, or 10 year, Indian markets will align. This growth story of 20 years will not last 200 years. Somewhere it has to align with China or America or other European countries where, stock market returns will fall in line with the economic growth of the country, which will not be so superlative for the next 50 years. Even if we achieve such growth, the price multiple of 25 or 28 or 22 is not sustainable over 10 years, 15 years from now. So as the economy of India matures, your price earning ka jo funda chalta hai, wo ghat jayega. So I fear that unless you have a proper asset allocation in these times, even if the markets are going one way, we must have a debt equity ratio gold allocation, and you should not go overboard in equity. I am a believer in equity, but not an over believer of equity that it will always perform. So one has to be very cautious, and this philosophy of Indian markets are cheap at all levels, I do not subscribe to this. So I'm very cautious even in this market. I'm telling my client, look, if you want to invest for 10 years, come on in equity. But, for 1 year, 2 year, 3 year time, you will always need to have a proper asset allocation. Don't go overboard for 2-3 years at all.
बहुत बढ़िया बात है. I think risk and understanding of asset allocation is very important. Maybe we have a very large, attendee panel here. तो एक ओरिजिनल लाइन है जो मैंने थोड़े दिन पहले सीखी है कि your birthday comes once in a year, but stock market में correction बार-बार आता रहता है. So we must remember that, but there is a difference in volatility and risk. And I think lambi avdi, which is what we talk about for equity, I think I personally feel that we have a long, long way to go. But asset allocation creates 80% of the value. You're absolutely right in that. And that is what saved people in 2020 when equity allocation had to be increased. Navlakiji, I'm going to ask pretty much the same and the obvious question. What are you telling your clients? And आपके पास जो एक broad advice है, for what is the best asset allocation? What is the best strategy for 1 year, 3 year, 5 year, and 10 years?
So I will take the analogy of milk on a chula. जब भी milk उबालते हैं ना, तो even if you put it slow, it will keep boiling and it creates cream. तो जब भी cream बनता है, वो थोड़ा निकाल दो, तो new cream can get created. If you don't take it out, you are not going to get the cream. So I think that's the logic to follow in markets, that, to the extent that you fear that the milk will boil over and some of it will get wasted, somebody else will get it, whether it is tax or, notional loss or actual loss. Then you keep taking out the cream and make sure that the level is such that it doesn't boil over. So that's a simple logic that one needs to follow. And when you need to actually take out the milk to add to your tea or coffee or drink milk separately, take it out. So link that to your goals. When I need that goal, I take out that milk from the bartan and put it into the glass. Then I'm using it and I'm enjoying my tea and I'm not worried about it.
मैं green tea पीता हूँ और मैं आजकल vegan हो रखा हूँ, तो मुझे क्या करना चाहिए?
हाँ, तो then you think about it. You drink beer or no?
अब वो इस पैनल पे शायद teetotaler ही रहना तो अच्छा है.
अच्छा, ठीक है. तो let us think about शरबत. right? Imagine that there is a tanki of sharbat or plain water. Let's say water is good for everybody. Let's take water. And there are different sources or different pipes going into that tanki which fills up your water. So you might have active income, you might have dividend income, you might have rental income, you might have different sources. Somebody is giving you a gift, Brijesh is transferring some wealth to you, whatever methods, right? So there are different pipes and it fills up your tank. Now you imagine in that tank there are different taps. You know, when you go to a wedding, you find that, you know, big tanki with lot of taps where everybody can wash hands together, right? So imagine that each tap is for a different purpose. One thing is for your child's education, one thing is for marriage, one is for going for movie, different thing. So each of these taps you can open to the extent that you require. If you're going for a movie and you're going with your spouse, then 2 tickets, you have to take out only 2 tickets ka water. No? You don't have to take out more. If you're educating your child abroad, then you have to take out a lot more water and so on and so forth. So unfortunately, what happens is that everybody treats that entire pool as one, that whole tanki as one, and say, "Arey, mera market upar ho gaya, market niche ho gaya." Actually, that's not what has happened. There are compartments within that tank which you are not seeing, because each of these taps is connected to a compartment, and you put only as much water in that compartment as you need. So if your child's education requires a certain amount, only that much should be filled in there. But you can draw it at later points in time. Or at least you know the capacity of the tank, even if you don't have the water today. So when you get the water, you know how to fill it. So I think this is what life is. And, you know, unfortunately or fortunately, in that tank where you have defined, let's say I have these 5 or 7 taps, suddenly one 8th tap will get introduced because some relative suddenly required money which you felt that you should give. So it was not part of your original plan, but now you've had to add a tap to this. So something else will get compromised. But at the same time, the speed of the water filling the taps will change. You will get a lottery like this 2 year in the market, as you mentioned. So make sure that you keep that extra water somewhere safe so that it is usable at some point and don't let it spill over. I think that is essentially what asset allocation is all about. That is what investing is all about. And then you have to just deal with the emotion of the client, which is the most difficult thing, according to me. Market is not difficult, ups and downs are not difficult. Holding the emotion of the client and making him become aware about certain things. And I think the biggest issue I face, at least, and I tell my clients this, sometimes they don't know that they don't know. And that is the most difficult part. If they knew that they didn't know, it is easy to explain to them what we think we should explain. So that I would think is the way to look at markets. I don't pay attention to the noise of whether it is 59,000, 50,000, 75,000. For absolute terms, inflation adjusted, market will always go up as long as you keep the base as 100, 1979. वो तो ऊपर ही जाएगा. I mean, people say, I'm surprised that it reached 50,000. When it was 20,000, I thought it will never reach. Now I'm saying you should not be surprised it reaches 1 lakh, it reaches 2 lakh, 3 lakh. The question is when and whether, you know, you are going to take benefit of that increase. So I agree with Brijesh that, you know, you have to be cautious. Don't get greedy. Because when things are going right, it seems like I don't need any advice. I can do it myself. जहाँ भी मैं arrow या dart shoot करता हूँ 100 points ही मिलते हैं. So the whole board is one bullseye. But at some point, you know, your vision improves and you start seeing only the middle is bullseye and everything else is minus points. So keep that in mind.
The equity market is ultimately buying purchasing power. मैं 2 examples यहाँ पे share करूँगा. When I moved to Bombay, I used to have a coffee for 5 rupees. Then it became a branded coffee of 50 rupees. And sometimes when me and Sumit, we go, we enjoy a cup of coffee for 200 rupees. In 20 years, the coffee price has gone from 50 rupees to 250 rupees. And Sumit knows that if I'm paying the bill, he'll take an extra chocolate and an extra large cup. So 300 rupees. Because it is nothing else but buying future purchasing power. Another example which I would love to share with everybody here, just for the benefit of the attendees here is, and this is a real life story. I happened to join television journalism in 2000. And this was exactly 1 month before 9/11. So here I started my television career and the biggest crash in the stock market happens. But in the last 22 years, I have reported assassinations, government change, 9/11, 2008, 2020. But I've seen the magical journey of Sensex. Nifty की तो बात भी मैं नहीं करता हूँ. 3,000 से 60,000. So that is what markets are, and that is what markets can do. So Mohit, अब आप बताइए, 1 year, 3 year, 5 year, 7 year. What are you telling your clients to do?
Look, so Nikunj, I kind of agree with Lois said, basically. And to me, I think the biggest message which we pass on to our clients is twofold. One, obviously, we keep harping to the point that if you keep money in your savings account, it will never make you rich, right? So you have to do something with that money. You have to earn that extra income, or you have to make your money work for yourself, right? So you have to try and figure out sources and avenues to build your passive income and to make your money work. So that's point number one. Point number second, which we keep harping on and which we keep believing is that the reality is somewhere in the middle. It is never in the extremes. अगर आप देखें आज से 2 साल पहले आपने नेगेटिव में ऑयल को देखा है और आपने अभी $150 पे देखा है, आपने एक बार $200 के आसपास भी देखा है, राइट? तो ऐसा नहीं है कि $150 या $200 पे सब कुछ खत्म हो गया, दुनिया बर्बाद हो गई, इंडिया खत्म हो गया एंड यू वेंट एब्सोल्युटली रेड ऑन योर पोर्टफोलियोज. वो भी नहीं हुआ. और जब ऑयल नेगेटिव चला गया था, राइट, एंड इट वाज अ शॉकिंग इवेंट, इट वाज अ न्यू लर्निंग फॉर एवरीवन ऑफ अस, स्पेशली फॉर मी एट दैट पॉइंट इन टाइम. तब भी ऐसा नहीं था कि दुनिया में कुछ चेंज हो गया या इंडियन मार्केट डबल हो गया सडनली बिकॉज ऑयल इज द बिगेस्ट बेन फॉर इंडिया, वी कीप हियरिंग, राइट? तो कुछ भी नहीं हुआ ऐसा. So my only thing, and that's what we keep repeating to all our clients, is that truth lies somewhere in the middle. Never react on extremes. वो बहुत euphoric way में अच्छा भी हो सकता है and extreme scenarios में गंदा भी हो सकता है. You have to ride through this journey, and asset allocation perhaps is the only way that you ride through this journey in a smiling way, right? और आप अपने goals define करिए, आप लंबी तरह से उसको इन्वेस्ट करते रहिए and just keep believing in that power. In a nominal term, the market will keep going up. That's what Lois said, and that's a fact of life, right? Inflation and the way central banks are printing currency, this market is not going to come down in a nominal term, right? In real terms, we can always argue कि earnings से adjust होगा, valuations थोड़े से nominal हो जाएंगे, valuations will revert to the mean and so on and so forth. But in nominal terms, it's a perma bull market, right? So you will keep going up because inflation will keep inflating the global economies, and you'll keep losing the value of your currency, and it will keep and to fight or to adjust to that inflation, you will have to invest in assets which will beat inflation year on year, or which will at least counter inflation handsomely. And uska aur koi answer nahi hai Nikunj, uska ek hi answer hai, which is equities, basically. So you will have to believe in the power, you will have to be more methodical about it. जहां तक 1 साल 3 साल 5 साल 10 साल का व्यू है, as I told, मैं इन सारे ही पैरामीटर्स पे बुलिश हूं. कहीं पर कॉशियसली बुलिश हूं, कहीं पर थोड़ा कम बुलिश हूं, कहीं पर थोड़ा ज्यादा बुलिश हूं. बट टू मी, आई थिंक वी जस्ट आस्क आवर क्लाइंट्स टू स्टिक टू देयर एसेट एलोकेशन. हम कभी उनको ये नहीं बोलते कि आप अभी इक्विटी में बहुत ओवरवेट हो जाओ because of whatever XYZ reasons or whatever. We will keep harping to them the same point year on year again. अगर आपका equity debt 60-40 है तो आप 60-40 पे चलते रहिए unless something dramatic changes in your lifestyle, your liquidity scenario, your requirements, your financial goals or objectives, or so on and so forth. Otherwise, for you and I to sit and decide just because रशिया यूक्रेन में कुछ हो गया, ऑयल में कुछ हो गया, गोल्ड में कुछ हो गया, पॉलिटिक्स में कुछ हो गया, कहीं पर भी कुछ हो गया, फॉर यू एंड आई टू डिसाइड कि अच्छा अब इक्विटी कम कर लेता हूं, अब खरीद लेता हूं, अब बेच लेता हूं, आई थिंक that's not the approach which we follow. So in a long term, if you honestly ask me, I think 3 to 7 to 10 year kind of a view, we have a long way to go. AUM as a percentage of our GDP is only 12%. The global average, I'm not talking US here, the global average is 63%. We have a massive way to go. Like it's not just a small way or something. We have a huge way when it comes to financialization of savings. I don't know how many times this data will get repeated on TV channels, on forums, that we are like 4.8% of our savings into equities today, right? The majority of the Indians are still investing into the yellow metal, still investing into that land which they have never seen or which they'll never go and check out, or which their generations will find very tough to manage and maintain, but they still continue to do that, right? Somewhere the new generation is trying and aligning to the new reality. They are not so much into physical assets. as they are into digital and virtual assets, which all of us are seeing a new revolution happening in front of us, basically. So I think that proportion of people investing in financial assets will keep increasing as the money finds more into the market. The markets will keep aligning and will keep growing, because finally the money is chasing those same stocks or the same blue chip companies and same everything, right? So I think a combination of all these factors makes me extremely bullish, sometimes cautious, sometimes optimistic, sometimes very, very careful. But the overall trend in me, or the overall optimist in me, doesn't change because of few reasons here and there, Nikunj.
There is evidence that world is contracting. Our GST collection, which came 5 days ago, is at an all-time high. Look at the neighborhood right now. There's a problem in China. Russia is becoming uninvestable. We know the unfortunate state of affairs Sri Lanka is in. I love to believe this little bit of channel positioning here. Rise with India, watch ET now. Sare jahan se acha Hindustan hamara. I firmly believe in that. So I'm going to take some questions now. The question from Mr. Vimal Shah. He's an attendee, and I'll throw it open. Anyone can answer that. The question is, rupee cost averaging in a falling market is favorable to investors. How investor can know the rupee cost averaging will not adversely impact the investment return? Anyone can answer this.
Look, finally, I'll just try and attempt that one. If you are doing investing for 20 years, 10 years, 30 years, right, a lump sum, technically speaking, will always work better if your view 10 years down, 20 years down is positive on the market, right? And if you go back in history and see, had you invested a lump sum chunk in 2010, 2005, 2000, whatever, 1995 or any time, and had you done SIPs from then till now, what would have worked better for you? Obviously, lump sum would have worked better, but your conditions, I think it's not about what approach works better. I think finally, after a point in time, when you continue doing a rupee cost averaging or SIP for 3-5 years, rather than averaging, it becomes a tool of accumulation. वो averaging जब आप 5,000 रुपए महीने का कर रहे हो, 5 साल बाद जब आपके कॉर्पस पे वो 5,000 रुपए इंक्रीमेंटली कुछ एवरेज नहीं कर पाएगा, वो आपको accumulation में ही help कर रहा है, basically. So finally, after a point in time, it's not averaging, it is mostly accumulation. That's my personal philosophy. It's a good tool if your income is sporadic, you don't have options to do that. But if you are like really bullish, you can handle volatility very well. Just go ahead and invest at lump sum and just wait for your money to grow. But I think it's more accumulation tool than averaging after a point in time. For first 2-3 years, it will work as an averaging tool for sure.
Rajesh, you want to comment on this one? When you start your journey as even in a SIP, एक तो पहले लोग मानते नहीं थे, अब लोग मानते हैं, तो they start a SIP but they don't increase it. What is the right way of looking at it? It's like this Hero on Honda ad, fill it, shut it, forget it. But ultimately, it's all about understanding inflation and how to create wealth. Rajesh?
So, Nikunj, I will just give a primer on the last question that, when you're talking about lump sum or SIP, first of all, there is no proven data which is better. SIP is better only because it reduces your risk. It gives you a slow poison kind of thing. If markets are going down, you don't feel that hurt. But I agree with Mohit that in 20 years' time, there's no data that SIP is better than lump sum. And of course, if the markets are favorable to SIP investors, SIP can be doing better. But there's no history of proving that, this is better or that. SIP only helps you reduce your volatility and makes you travel that 20 years. So if you are not able to handle volatility, SIP is better. The other thing, which we have been telling our clients successfully is that, it is not, and the theme of the event, not timing the market, but time the market. So if you see any portfolio which start on day one, up to 10 years to 15 years, the component of your investment is more than 50 to 75% of your total portfolio value. Because, the compounding happens only after 10 and 15 years. So if you do a 10,000 rupees SIP for 5 years, you have invested 6 lakhs, and that at best will become 7.5 lakhs or 8 lakh rupees. So on an 8 lakh portfolio, your contribution is 60% and your appreciation is only 40%. So I tell our clients that, for the first 10 to 15 years, it makes no sense where you have invested, what returns you are getting. Because 70% of your portfolio value after 10 to 15 years is your own money. The compounding will start after that. So when we suggest SIP to the clients, we tell them that, this is your money and you are saving this money. Returns will come after 10 years. Unless you wait, compounding will not happen. So people have understood this fact that, there's no returns come secondary. Just increase your SIP. And we have been harping, and motivation is a daily pill. Behavior management, as Lovai said earlier, is a daily pill. Every day we have to repeat the same sentences to the client over and over again. And you do the same thing over and over again in the last 20 years about equity and stocks and everything. So, it is a daily thing that we have to do. So every day we have to tell our clients SIP, SIP, SIP. और उनको नहीं भी समझ में आता है तो समझ में आता है ब्रिजेश बोल रहा अच्छा ही होगा डाल दो बढ़ा दो. So and somehow it is working, for us, for the clients. And now the clients, for example, today only our client खुद से phone करके बोलता है मेरी 2 लाख की SIP बढ़ा दो. So now this concept is there, and last 20 years hard work of all of us together has made this concept very clear that कि SIP करना है तो stretch करके करो, conservatively मत करो. और अगर लोग कहते हैं कि अगर ताकत होगी तो बढ़ा देंगे, मैं उनको बोलता हूं कि ताकत नहीं होगी तो घटा देना. And this works very well.
What a nice thing. So gentlemen, it's been a pleasure absolutely interacting with all of you. मेरे को याद है 2020 में हमने जब वॉयाज डिजिटल करी थी तो उस समय डर था. उसके बाद हमने सेकंड वॉयाज करी 2021 में. उस समय थोड़ी खुशी आ रही थी, मगर इस समय एक जिसे हम कह सकते हैं माहौल ऐसा हो रखा है that everybody is feeling relieved, people are feeling happy, markets are at a record high. So that theory of buying the fear and selling the greed once again has really proven true. Keep the belief going, and it's just been such a pleasure to interact with all 4 of you and to understand that the equity cult, what we're talking about, why Indian investors are really changing the asset class allocation. Not only it's a permanent temporary trend, it's a permanent trend. I think that endorsement is very important if it is coming from some of the top distributors. So Sumit, I'll pass it on to you. Thank you for setting up the tone for this session, Sumit. But I think the key takeaway really, Sumit, we've been doing these sessions for so many years now. About the 5th voyage we've covered together. And you remember, Sumit, earlier we had the challenge of convincing people that why equity is better. Now we have to convince people to stick to asset allocation.
Absolutely, absolutely. Well said, sir. Thank you. Well, that was a great session. As I told you, it will be one of our best sessions, maybe I could say, or at least one of the most interesting ones. We got such great insights. And like Nikunj said at the end, it's very true. Nowadays, asset allocation is what we need to be talking to people about. And we will be discussing that tomorrow. So you definitely want to tune in tomorrow. One important thing, Nikunj, before you go, one other thing also, one takeaway from me is that next time, if you're paying sir for the coffee, I will be maybe going to a more expensive restaurant or a hotel and adding something to eat in that as well. Okay, ladies and gentlemen, as we wrap up, first up, as you've been doing, the ratings for the session must have come up. Please do rate on that. I do want to talk about the contest and a quick wrap up on the day. Before that, as you can see at the bottom of your screen on the right, next to the question tab, there is the feedback button. Please do click on that and do leave in your feedback, your thoughts, your suggestions, most importantly, on how you liked, what you didn't like. Do tell us about that, and we will try our very best to incorporate that into tomorrow's session and definitely for the future editions as well. A big thank you to Mr. Navlakhi, Mr. Bansal, Mr. Brijesh Dalmia, and Mr. Mohit Gang for coming on the panel and sharing their thoughts. It's been an amazing day. As always, Voyage is we started off with A. Balasubramanian, the MD and CEO of Aditya Birla Sun Life AMC, and he spoke about how they are bullish on India's long-term growth. He shared some great statistics and numbers that has set the tone for the day today and for tomorrow as well. So that was very interesting. It was a great start. This was followed up with a session with Mr. V. Ananta Nageswaran, the Chief Economic Advisor. He was in conversation with Nayantara Rai and Kaustubh Gupta. He made some very interesting comments. He spoke about how India's growth rate will be driven by capital expenditure and consumer demand. Some very important points there, and he said he was very open, I felt, and he shared his thoughts very well on the topics of the moment that were put forth to him. This was followed by Mahesh Patil, the CIO at Aditya Birla Sun Life AMC Limited. He spoke about how markets have been very resilient and have bounced back. A very important point, that have bounced back. That is most important. And also about, he spoke about how India's GDP growth rate is recovering well, which is great news, which is music for everybody's ears. This was followed by a very insightful session with Mark Mobius, the partner at Mobius Capital Partners, with Nikunj Dalmia. He spoke so much about India and emerging markets and his take on India's desirability as an investment destination. He had a very important thought, which I felt, where he spoke about it's critical to invest in companies with earning power and low debt. Basically talking about the topic, which was the art of investing. So he spoke really on point about that. Then we had a session with Atul Penkar, Satyabrata Mohanty and Anil Shah, and they were talking about portfolio strategies for consistent growth. Important point that they said that historically India is underinvested in infrastructure. Very important point, but I think that trend is changing. We will be talking a little bit more about that tomorrow, because we have a sector specific panel lined up for tomorrow. And they also spoke about how to manage the portfolio related risk. Again, very important. And finally, we wrapped up the day with this panel with mutual fund distributors who spoke to us about their journey, about how they've spent over 3 decades in the industry, how they've seen things change. Most importantly, how they've seen the evolution of the investor and the investor's perspective, how investors now are maybe not so panicky when the markets go down, and how their investment process, investment wants, their goals have changed over time. So that was really interesting, I felt. Before I forget, we did a poll just before the distributor panel. If you remember, that was where we asked you that with most of your clients, what is their preferred method of interaction with you? A whopping 51% have said in-person meeting is the preferred method. So that's, wow, that's really amazing. That's still in-person meeting, जो आमने सामने की जो बात है उसी में अभी भी दम है. About 27% said WhatsApp, SMS, 15% said a phone call, and 7% said email. So which is really interesting and quite a very revealing poll there. Right, so that is all for the day. Before we go, as you know, we've been doing some contests today. There's the Smart Twitterati contest, the Active Voyager. We're also asking you to tweet and share your thoughts on why you love Voyage 2022. We will have all those winners announced tomorrow. Don't worry, we have not forgotten. You can keep the conversation going. Just tweet with the hashtag Voyage 2022 and tag us at ABSLMF. Important, tomorrow, 3:30. Please do join us. The lineup is stellar. We are starting the day with Mr. KB Kamath. He'll be speaking on the outlook on India's BFSI sector. This will be followed by a panel on market outlook for fixed income. We'll have Bhupesh Bameta and Sunena Dakuna from Aditya Birla Sun Life AMC on that. Then later in the day, we have the co-head of Asian Economics Strategy and Commodity Research at Goldman Sachs, Tim Moore. That's right, Tim Moore will be in conversation with Nikunj Dalmia. You definitely want to be in for that session. And we're also, like I said earlier, we're talking to fund managers and senior analysts from Aditya Birla Sun Life AMC who will be giving us the sector outlook. They'll be talking about asset allocation, the key point that we're taking back from this previous panel. Well, that's enough from me. Thank you so much for joining in, and I hope you've enjoyed the session today. But tune in tomorrow, 3:30 p.m., same place, for some more sessions and a lot more interesting conversation here at Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. This is Sumit Lakhotia from ET Now, signing out. See you tomorrow. Thank you.